India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. This is an important week. We're kicking this off this Monday. It's the budget week. Tomorrow, of course, is the union budget, and I think all eyes on it in terms of what it sort of gets us our way. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning, Nigel. It's so hard to keep up with all the events, right? I mean, when the Microsoft outage happened, I thought that was the only historic event we'll have to report. But lo and behold, in 24 hours, President Joe Biden has now dropped out of the presidential race. So we really have our hands full in terms of cues.
Well, that's right. We have big results as well, earnings reactions, and the regulators, well, they're making their stance quite clear with regard to the market. So we'll have to analyze that as well.
Absolutely. That outage was quite something. I was actually on a flight, and it just was crazy. I mean,
cybersecurity has now become the hottest topic that everyone's talking about, right?
Absolutely.
It's unnerving. So that's the only way to put it.
Absolutely. And, we'll talk more about that one because it's got implications, of course, over a sort of longer time scale, and companies have are taking notice as we speak. But let's get it back to the market now, right? Because, I mean, that's what we do right as we kick off the show. Friday was a bad session. Friday, broader markets sold off and sold off hard. And I remember saying this in the morning on Friday, that Infosys, no Infosys. You basically have the market which is looking a little iffy, looking a little jittery. Infosys was up 2%, 3% off the day's high, but the rest of the market just completely collapsed. So broader market especially got hammered. The mid and small cap indices were down over 2%. It was a combination. Global cues had been weak the last 2 days. There was, of course, overextended positioning, so there was profit booking in that sense. And, of course, a little bit of pre-budget nerves, which I think are starting to build in. And that's natural because markets have done extremely well. We're up about 12% of the Nifty, even after Friday's fall from the June 4th close, which is the election day close. 12%. And, small mid caps are up 14, small caps are up 17, 18% since then. And you're kind of going into a big event, which is the budget. Even though people may say, well, importance of budgets have come off, and that's true. But markets react to incremental change, and in that sense, it is important. Rupee also, by the way, traded at a new all-time low against the US dollar on Friday. I mean, both in the India session and in the NDF, the sort of later session as well. And we'll talk more about that. This morning, we've got news that, US President Biden will not run for another term as far as US presidentship is concerned. He's dropped out of the US presidential race and he's endorsed Vice President Kamala Harris as the next nominee. It's interesting, and we've been sort of discussing this, that the pressure on Biden is kind of building up for him to, because of health reasons, etc., for him to step aside. There was a recent sort of bit of polling which was done by APNORC, which found that Harris's favorability with American voters is similar to Joe Biden, although she's less unpopular as compared to Biden. I mean, again, I think a lot of commentary, a lot of sort of discussion would be what the market implications of this is. But if you just looked at what the S&P futures were doing this morning, once that news broke, nothing. I mean, they were up about 10, 12 points the last I checked. So this was expected. I mean, on Friday, we were saying that something is expected by the weekend, and it has indeed come through. This is the close on Friday, though, for Wall Street. S&P down 3/4, NASDAQ down about 0.8%. Yields were up 4 basis points on the 10-year. Dollar index went up about 1/4, and Brent prices fell about 3% or so. Again, in terms of if you're looking for one reason, one reaction, you won't find one. U.S. and India have been the best performing markets, and you're basically seeing a little bit of unwinding from overextended positions. You have the core PCE data this week in the US, which will be very important. And you also have earnings. 35% of the S&P market cap will report numbers, including 3 of the Magnificent 7 companies. Tesla, Microsoft, and Google will be reporting. So I think it will be pretty important to track. Now, just to come back to the levels here, I think the advice is what I said on Friday morning as well. Step aside because, you have I think, again, the color is red this morning. not just because of global reasons, which clearly are indicating further pressure, but also because we have broken some moving averages. So for the Nifty, the important support is the 20-day moving average, which is about 150 points away, 24,214. I think if we get a 100 point kind of cut, you'd be starting to wonder if this goes. Nifty Bank is already below its 20-day moving average, which is 52,453. So keep an eye out on that one on the ups. I mean, basically, as long as you stay under it, and the 20-day moving average in the short to medium term can mark reversals. Not always, but this is also happening at a time when we are going into the budget. And budgets themselves, go back the last 15, 20 years, have marked a bit of a turning point, a turn as opposed to whatever the trend has been prevailing before the budget. So, that complicates matters more than anything else. Both the mid-cap and small-cap indices are also below their respective 20-day moving averages after the sell-off that we saw on Friday. So the advice is same, step aside, let the budget event pass, and then I think the market will find some semblance of stability one way or the other, and then we can take a fresh call. The economic survey today, and of course the union budget tomorrow. GIFT Nifty will indicate what the opening is looking like this morning. It's 142 points straight off, as far as that is concerned. So it's pressure once again, not just because of global reasons, but because of some pre-budget nerves as well. Sonia.
Absolutely. So I think two main reasons why the market could be under pressure today. One, of course, is the way the global market has sold off, right? Yeah. And the other is some of the large caps like Reliance and HDFC Bank have not delivered numbers in line with expectations. In fact, there has been weakness across both these top earnings, and hence that could put some pressure on the markets today. But on that subject of, what's happening with the US presidential elections, now perhaps there are higher chances for the Republicans, right? With Kamala Harris coming on board. At least that's what the narrative is, purely because of, I think Harris's popularity also dipped after the genocide and, all of that talk there. So let's see what happens with Donald Trump. The latest statement that he made is that it's easier to defeat Kamala Harris than Joe Biden. So very interesting, events taking place there. But for our own markets, the US markets were under quite a bit of pressure actually on Friday. So keep that in mind. Reliance will be reacting to its earnings today, and my expectation is that the street could react negatively because the oil to chemicals business was on the weaker side because of macro concerns. There are some brokerages that have scaled down their estimates as well. Although Geo and the retail business was stable, but because of weakness in the oil to chemicals business, the stock could be under pressure. Remember, the stock has also gone up 15% in the last 6 months. The other reaction will come in from HDFC Bank and Kotak Mahindra Bank. Over there as well, there are some brokerage downgrades. JP Morgan, in fact, this morning has downgraded HDFC Bank to a neutral, cut its target price to 1,700 and said that there are expectations of weaker loan growth for HDFC Bank. So I reckon there won't be any support either from HDFC Bank or from Reliance, and hence that could put the market under a bit of pressure. There's the union budget tomorrow, so all eyes will be on that. Although I do feel that a lot of the positive surprise that could come because of the higher tax collections, higher dividend from the RBI, all of that is perhaps priced into the market. Now the market is a bit on the back foot because of weakness from the globe as well as from Reliance. But a lot of numbers this week as well. There's HUL, there's Axis Bank, Ashok Leyland, DLF will be reporting their earnings this week. So we pretty much have our hands full, but looks like it's going to be a weak start today.
Well, that's right. Some nervousness going into the budget event as well. And also Friday's trading session was a rather weak one. But one positive that stood out for me was the FI flows. And that's returned. And in fact, the Indian markets are getting a larger chunk in terms of those flows. That's why, if you look at it for the last week or so, we got roughly around $600 million odd, while other emerging markets, well, they in fact saw outflows. Taiwan, notably out there, more than $5 billion getting pulled out of there. So the FI flows, they're good. And mutual funds, the liquidity they're sitting on as well is quite good. So put both those factors together, I don't expect a very, very large cut in the Indian markets, irrespective of what happens. What about the FIs? So what do they do in the F&O market? They unbound some long positions. So part of the fall could be attributed to the unwinding of long positions ahead of the big event, though the short positions now have moved up marginally to around 21% odd. And if you look at it in absolute terms, the FI net long positions had moved closer to around 4 lakh contracts odd. That's come down a little bit to around 3.58 lakh contracts. The client positioning, that's been on the short side, but they've covered some shorts actually. If you look at it from the start of this series, it was closer to around 3 lakh contracts. The short positioning has now come down to around 2.1 lakh contracts odd. What about the options data? Well, the options data, we did see some bit of call writing at higher levels. 24,700 call, that saw a fair bit of addition, and the 24,500 put as well. which brings us to the levels. The 20 DMA is very important, closer to around 24,200. The options data suggests that support is in this vicinity of around 24,250 to 24,300, while the recent high, that becomes the crucial resistance mark at around the 24,900 odd. The Nifty Bank as well, that ended marginally below that 20 DMA that it was supporting for a bit. If you look at the options data, well, there is a support zone at around 51,750, 51,800. Just a few sessions ago, we went down to around 51,750 odd. So that mark becomes important. The start's in the red. Let's see whether or not at some point of time we see an intraday recovery. I think around that 24,250 mark on the Nifty, that becomes extremely important level that we hold out, which gives the chances of a bounce a little bit more.
All right, Nigel, thanks a lot for that. So very helpful there. Lots to watch out for today. But very quickly, let's get you some opinion as well. Vikas Jain of CLSA says that their proprietary India Bull Bear Index points at a 92% bullish investor sentiment, the highest ahead of any budget in at least 15 years. He says such an extreme sentiment reading along with stretched valuations makes the market vulnerable going into the big event. He says after a huge 54% rally in 8 months preceding the election results, Modi's stocks have been flat since when other stocks have risen 12%. He fears elevated expectations from the budget is causing disappointment across a large part of the market. He says they have adopted a low beta strategy for CLSA's India-focused portfolio and recommend investors to actively reduce risk going into the budget.
All right, well, that's the equity view. Well, let's get you some money market views as well. This is on the rupee. B. Prasanna of ICICI Bank says the resilient consumption data in the US showed a bumpy path of slowdown in the economy and halted the slide of the dollar. Rupee weakened slightly, but within a narrow range as RBI continued to accumulate reserves against inflows. This week, the currency market will get used from the US PCE data and election-related news. For this week, Prasanna expects the rupee to trade in a narrow range with slight weakening bias between 83.55 to 83.85 to the dollar.
And on the bonds, Prasanna says that globally bonds consolidated in absence of fresh triggers. Back home, all eyes are on the upcoming union budget, where expectations are for an increase in revenue expenditure, capex and marginal fiscal consolidation, along with reduction in the borrowings via T-bills. Core liquidity has been improving on the back of forex flows, inducing steepness in the yield curve. He expects a positive momentum to continue with the benchmark 10-year yield likely to trade in a range of 6.9 to 7.05%.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. But let's highlight the stocks we're looking at. HDFC Bank, JSW Energy, Patanjali Foods, Poonawalla FinCorp, all of them will be reacting on the positive side, while on the flip side, you have Reliance Industries that will be reacting to negative news flow, Wipro, JSW Steel, Kotak Mahindra Bank, Indian Hotels, and ICICI Lombard.
Okay, well, let's get you some perspective. Ed Yardeni, President at Yardeni Research, is joining us now. Ed, good morning. Good to have you with us here. Thank you very much for your time here. Prashant this side. So, two questions. One, there was this nascent recovery in small caps in the US. That, for the last 2 days, has gotten sold into. That is one. I mean, what's happening there? And second, implications for markets of this Biden announcement.
Well, I think with regards to the rally that we had in the small cap, some of that was short covering. Some of that was very specific to biotech and banks, regional banks that had been knocked down last year, had a big recovery in a couple of days. But then people had some second thoughts about it and had a closer look at the earnings story in this small cap area. And it's not that exciting. It's been kind of flat for the past 2 years. I think one of the structural problems in the small cap area is all the good companies get bought out before they go public. I don't know that we'll ever find a Microsoft again, in the sense that if there's a Microsoft out there that's just a newbie, just kind of growing, it'll get bought out before it ever goes public. So I think that's an issue. With regards to Biden, as you said, so far the preliminary evidence on the S&P futures is that it's a non-event. Look, the political situation is so crazy here in the U.S. that the stock market simply has decided, let's just tune it out until we get the next president and see what the next set of policies are all about. It's a very fluid situation.
Actually, that's true because we haven't seen any kind of volatility in the US markets despite all the back and forth, the yo-yoing of the presidential candidates, the health, etc. Right? So that's actually a good thing to be disassociated from the political news. But back home as well, we have a huge event upon us. There's a union budget tomorrow. The markets have, after a big rally in India, started to correct a tad bit. Now, we don't know if this is time consolidation or is it price-wise consolidation? But in your opinion, what's the best way to approach the market now in India?
Well, I think things are changing for the better in India on a regular basis. I kind of like the election results, that there's still some checks and balances in the political system, but I think the government of Modi remains very much in charge, and I think they're going to be able to get some of their reforms through and some of their areas in tax cuts, particularly on the capital gains side. So I think that all is positive for the market. The market's discounted a lot of good news, but it is a positive. For foreign investors, it's tougher because the rupee keeps going down. So you make money in the Indian stock market, but on the other hand, you translate it to other currencies, it's not working out that well.
Hi, Ed. Morning. Good to see you, Ben. Ed, from an Indian market perspective and emerging market perspective, the street believes that President Trump will be much better than any other candidate because if President Trump comes in, the dollar index is likely to be a little bit softish. And given his relationships with India, India is likely to be a beneficiary. Would you agree?
Well, I think it's too soon to tell, quite honestly. Just to be brutally honest about it. There's a lot of uncertainty. Just because Trump says that he'd like to see a weaker dollar doesn't necessarily mean that's going to happen. And I think that, clearly the Trump policies are a mixed bag. On the negative side, there's a lot of talk about the tariffs. And I think he's using it right now as sort of a bargaining approach to China. But if this thing with him accelerates into a trade war, that wouldn't be good for the U.S. It wouldn't be good for China. It wouldn't be good for world trade. So I think it's a little premature to conclude that Trump is definitely a positive for emerging markets, that Trump is definitely going to have an impact one way or the other on the dollar. The fact of the matter is the U.S. economy is very strong. It's doing remarkably well relative to other countries, and that typically favors the dollar.
Got it. Ed, we'll leave it there for now. Great conversation as always. Thank you very much that you were able to join us and shed light on many of the sort of dominating issues in the market. U.S. politics is dominating but not driving. Not for now, as Ed said. Mark is just saying, well, let's take a call once we're closer to it. Now, the flight of capital from household savings to other financial instruments has the RBI governor and SEBI chairperson both worried. Both the regulators spoke at different events on Friday where they aired these concerns. Speaking at a Financial Express event, Governor Shaktikanta Das said slowing deposit growth can create structural liquidity issues. SEBI Chief Madhavi Puri Bush said it's time to consider if household savings are going into speculation instead of capital formation. She was speaking at a SBI mutual fund event. SEBI Chief also said the surge in volumes across futures and volumes is now a macro issue and not just a micro issue of investor safety. Let's play those bites out.
Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries. While bank deposits continue to remain dominant as a percentage of financial assets owned by the households, their share has been declining, with households increasingly allocating their savings to mutual funds, insurance funds, and pension funds. To be precise, households are increasingly turning to other avenues for deploying their savings instead of banks.
Micro objective of protecting the individual investor has changed and morphed to thinking about the macro issue of saying, is this what our market is designed to do, to basically facilitate a lot of speculative transactions? Or at a macro level, are we worried that household savings are now going not into capital formation, but into speculative activity? What has changed over the 3 years, the facts that have changed, is it has gone from being a micro issue of an investor to a macro issue of the economy itself. Every time we introduce something new, it's because we say we recognize that there is a market demand for it. We need to give a good regulated environment to the investor to meet that demand. So it's clear to us the investor wants to take derivative positions. Why are we leaving him without an option to do it through a professional fund manager? So that was one of the factors that drove that consultation paper.
Well, in fact, we spoke with, AMC's mutual funds and market participants over the weekend. And we'd like to get you some reactions here on what the SEBI chairperson and the RBI governor said. This is Nilesh Shah of Kotak AMC, who said, and I quote, "I think the SEBI chairperson is absolutely right in stating that F&O activity is both a micro as well as a macro issue. And from a macro point of view, according to Nilesh, there are issues of savers becoming speculators rather than investors, resulting into misallocation of savings and low capital formation. From a micro point of view, there is a need to create a level playing field between local and global participants in F&O." We also had Swarup Mohanty of Mirai AMC, who said, and I quote, "The number of people who have started this return chasing is scary. While the market cap and the number of available stock and free float seems to have widened, what does not change is the liquidity status in the market. Everything is okay until inflows are higher than outflows. The day that changes, it can go totally in a very wrong direction."
Okay, well, lots to talk about in terms of individual stocks as well. So let's take a quick commercial break. On the other side, we're going to be reacting to a lot of numbers today. There's Reliance, HDFC Bank, Kotak Mahindra Bank, all of that coming up in a bit. Welcome back to Bazaar Morning Call. This morning, the GIFT Nifty is indicating a very weak start, and there are a couple of reasons for that. One of them is that global cues have been on the weaker side. The other one is Reliance could be reacting negatively to its numbers, largely because of the oil to chemicals business, which has been weak on account of the weak macro data. So let's talk about Reliance a little bit. The earnings overall have been steady, but it's the oil to chemicals business which is dragged. Otherwise, Jio and the retail business were steady state this time. Let me just take you through the core numbers. As you can see on the screen, revenues up 11.5%. EBITDA barely grew about 1%. The margins have actually fallen to 16.7% versus 18.4% year on year. And the profits were down 5.5% for Reliance Industries on a consolidated basis at 15,138 odd crores. Now, I just want to put the brokerage views on board to tell you what the way forward could look like for the stock. Nomura put out a note where they said that it is an in-line quarter. They reiterated a buy. They've raised their target price to 3,600 on Reliance Industries. Jefferies says that revenues have actually missed street estimates and the subscriber addition has been on the weaker side for Reliance Jio. Macquarie says Q1 was a material miss due to lower than forecasted Jio and the oil to chemicals business, and they continue to see a downside risk to the consensus estimates. They maintain neutral with a 12-month target price of 2,750. Just to reiterate, the oil to chemicals business was weak because of the macro situation, and that was expected. Hence, the stock, after a 15% rally in the last 6 months, could come in for some profit taking today.
Okay, all right. Sonia, thanks a lot for that. Well, let's hop across to Abhishek. He's joining in with the other big number, which is HDFC Bank. Morning, Abhishek.
Morning, Nigel. So HDFC Bank has beaten our poll with respect to their P&L, both the NI and the PAT. Net interest margin has actually improved by 3 basis points sequentially. Analysts were pegging in net interest margin to remain flat on a sequential basis. So this is a positive surprise. Operating profits, they are down 18.4% quarter-on-quarter. Remember that in the last quarter, they had an exceptional gain with respect to treasury gains. So if you remove this treasury gains, operating profit have grown by 9% sequentially. Now provisions are down 81% quarter-on-quarter and PAT is down 2% sequentially. Asset quality, some deterioration seen over there, but it's largely seasonal in nature given the fact that agri portfolio sees higher NPAs in Q1 of any year for them versus Q4 of the previous fiscal that they have had. So P&L NI is a beat of 0.9% and PAT is a beat of more than 3% for HDFC Bank. Back to you.
All right, Abhishek, thank you very much for that. We'll come back to you for more earnings, but JSW Steel is the next one we want to focus on. Nigel, what do the numbers look like?
Well, that's right. JSW Steel's numbers, they were a little bit disappointing, actually. On the top line, though, it was a little bit better. Why is that? Because they've been focusing on their product mix and on VAP. And because of that, on the realizations on a sequential basis were more or less flattish. So that explains why on the top line, there was a bit of a beat, though the margins were a little bit lower than what we were working with. Let's break it up into two parts. One is the standalone business. That did well. There was some marginal improvement in the standalone EBITDA per ton on a sequential basis. And on an EBITDA per ton, well, it was a little bit better than what we were working with. So good going on that front. And on a sequential basis, as I mentioned, it moved up by more than 400 rupees. The problem was the international business. The US plate and mill business, out there you saw a contraction in the EBITDA number. Also, the Ohio business, there was a loss, and that loss went up from around 5 billion to around 15 million odd. So that was the problem pocket out there. The net debt as well moved up because of the capex that they are incurring. But the management believes that the return ratios will stay constant. So on the back of that margin miss and the pressure we saw in the international business, going with red on this one. In fact, we'll have the management who will be joining us in a short while from now. So remember to tune into that conversation at 9:40 a.m. later today. Let's focus on the other big number, Wipro. Rima, that one's numbers, in fact, were disappointing. And the problem is the stock has seen a big run up to these numbers.
Indeed, and that's the reason why the Wipro ADR was also under immense pressure on Friday. It was down 11%. So Q1 was a miss. On Friday, also stock had, adversely, in anticipation, perhaps of weak numbers, it had corrected 2.5%. But still, since the beginning of June, it's up close to about 27%. So Q1 was a miss on revenues and a miss on the next quarter's guidance. Revenues have declined by 1%. This marks the sixth consecutive quarter of a revenue contraction for Wipro. The Q2 guidance is also a miss at -1 to +1%. Morgan Stanley says expect Wipro to continue to lag peers on revenue growth in the near term, which will keep its PE multiple at a discount to peers. They're seeing early signs of a recovery tailwind, but Wipro needs better execution to benefit from there. So, a bit of a run-up in anticipation of a turnaround, but that's not played out, and the stock could be under pressure today.
Okay, thanks a lot for that. Wipro never fails to disappoint, doesn't it? I mean, I don't remember a single quarter when Wipro actually outperformed. Maybe one in the last 10, 15 quarters. But anyway, moving on, Kotak Mahindra Bank, Abhishek is here to tell us how that one looked. Abhishek, over to you.
Well, another disappointment after Wipro, you could call Kotak Mahindra Bank, because the net interest margin has actually declined to an 8-quarter low, despite the fact that their CD ratio or credit to deposit ratio has improved. So operationally, a weak quarter for Kotak Mahindra Bank. Take a look at the net interest margin. It has come in at 5.02%, which is a decline of 26 basis points on a sequential basis and 55 basis points on a YOY basis. So deposit growth is at 15.8% YOY and decline of 0.3% sequentially. YOY is the lowest growth that you are seeing in last 6 quarters, and for the first time in 16 quarters, the deposits have declined on a sequential basis. Now, advances growth was healthy at 18.7% YOY. It's the best growth that you are seeing in last 6 quarters for them. Operating profit grew by just 6% YOY and it declined by 3.8% sequentially. So the 6% growth rate of operating profit is one of the weakest in last 6 quarters or 8 quarters. Provisions that have increased sharply by 59% on a YOY basis and about 119% on a sequential basis. So PNL, the NI is a miss on our poll. However, on account of the one-time exceptional income that they have had through stake sale of general insurance business, the PAT has come in at 6,250 crore. We are working with a number of 4,000 crore. Back to you.
All right, Abhishek, thanks very much for that. JSW Energy is the next one we want to focus on. Vivek has got details. Vivek, morning.
Well, good morning. So JSW Energy came out with a good set of results. Operationally strong quarter, largely aided by generation volumes higher by almost 18% on a year-on-year basis. However, one thing to keep in mind is that amongst the entire power universe, this particular stock trades at a steep valuation, and that's something that brokerages have highlighted. Now, talking about what impacted the quarter in terms of even operationally, Vijayanagar and Barmer plants saw slightly lower utilization on the back of planned outages. Profits were aided by lower net interest costs and depreciation, and also aided by the QIP fundraise. Now, talking about the actual numbers themselves, revenues down by close to 2% on a year-on-year basis, coming in close to the 2,880 crore mark. EBITDA higher by 16%, coming in close to the 1,418 crore mark. Margins are expanding quite significantly on a year-on-year basis, coming in at 49.2% versus 41.7%. Profitability higher by 80% on the back of the factors that I just mentioned, coming in close to the 522 crore mark. Now, talking about the plant availability factor, continue to stay above the normative PAF of almost 102% that we saw in the same quarter last year. Interesting to see, expect some green on the stock at the opening. Interesting to see whether it sustains.
Thanks a lot for that, Vivek. In fact, we'll have the management joining us at noon later today to give us an insight about the last quarter's numbers as well as the way ahead. But let's hop across to Mangalam. He's here to tell us about Indian hotels. Hey, Mangalam, morning.
Good morning. So it was a seasonally weak quarter for the hotel industry itself. So in that light, Indian hotels also performance was largely soft. But, that's something that the street was anticipating already. Why is that? Because there was the election. So government-related, business didn't come by. There was the heat wave. And there were 25% lower wedding dates as well, as a result of which there was lower wedding revenue too. So 5.7% growth in the overall revenue of the company. The EBITDA grew by just about 10% and the net profit grew by 12% as well. If you look at the occupancy during this quarter, it was up 1%. The domestic average room rate was up around 2% as well. So in a seasonally weak quarter, the company was fairly resilient. They've continued to maintain their double-digit revenue growth guidance for the full year. So see mild red on the stock, and chances are that maybe if the market recovers, then we could see some recovery on Indian hotels as well.
Okay, all right. Mangalam, thanks a lot for that. Well, I'm looking at JK Cement and I'm expecting the stock to react favorably to its numbers. Let's run you through the data points then. Top line, there was a bit of a growth of around 2%, though realizations remain under pressure because the volume growth was at around 6%. The EBITDA number, that jumped up by close to 19% on a year-on-year basis, and margins improved as well on a year-to-year basis. Comes on a lower base, but these numbers look good. There were two key factors out there, and this is a cost-focus-driven beat, because the power and fuel costs were down sharply, and the other expenditure, when you have volume growth of around 6% and the other expenditure goes up by only around 1%, that helps you in terms of operating leverage as well. The net debt, yes, it's moved up marginally, but that's par for the course because the company is at a capacity of around 24 million tons odd, and they've already outlined that in the next 2 years, they'll move to around 30 million tons odd. So expecting the stock to open up in the green. That's about JK Cement, but let's wind this down with Mangalam, who's here to tell us about Patanjali Foods. Mangalam.
Well, looking good for Patanjali Foods, largely because the edible oil cycle is turning in the company's favor. So to that extent, I'll watch out for any sort of reaction, even on Adani Wilmar. So revenues for the company were down about 7.6%. That's largely because, they've taken price cuts on lower oil prices, but gross margins have improved. The EBITDA has actually jumped 140%. And on the back of that, the net profits nearly tripled from 88 crores to about 263 crores. So the edible oil segment, which was an EBIT loss-making segment same time last year to the tune of almost 150 crores, has made an EBIT profit of close to around 200 crores as well. The FMCG business, the revenues were flat out there. The EBITDA was down by almost 50%, but that's largely because the company spent more on ads during the IPL. So we'll get more detail on this business going forward. The key to track for Patanjali Foods now is the growth through acquired personal care and home care businesses of Patanjali Ayurved, the announcement that they made earlier this month itself. So to that extent, see a lot of green on Patanjali Foods.
Okay, well, let's go across to Abhishek to catch up on Poonawalla FinCorp and how that one looked. Abhishek, over to you.
Well, seasonal impact did have, on the disbursements of Poonawalla FinCorp. Disbursements are up just for 4.8% YOY and they have declined by 23.6% sequentially. However, the AUM growth remains strong. AUM growth is at 51.7% YOY and about 7.9% sequentially. Now, calculation shows that the net interest margin might have contracted by 45 basis points on a sequential basis, which is, a disheartening point to see that NBFCs are losing on net interest margin. Other income was up robustly, which helped the overall net income for the entity. Now, the PAT is down about 12% quarter on quarter because they made provisions with respect to, writing down the asset quality or writing off the gross NPA. So, look at the asset quality. Gross NPA ratio has improved to 0.67% versus 1.16% in the previous quarter. Net NPA ratio has improved to 0.32% versus 0.59% in the previous quarter. So, asset quality improvement may go down well with investors today. Back to you.
Okay, thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow: HDFC Bank, JSW Energy, Patanjali Foods, Poonawalla FinCorp and JK Cement. while many large caps with negative news flow: Reliance Industries, Wipro, JSW Steel, Kotak Mahindra Bank and Indian Hotels. But let's also get a quick roundup of what's been happening in the world of commodities. There is so much that's happening across the world that, of course, it has ramifications on the commodities as well. Manisha Gupta is joining in. Manisha, hi, good morning.
Morning. Absolutely, Sonia. There's just plenty happening in commodities as well. If you look at the crude oil prices, we are now trading at around 5-week lows after 3.5% of decline in the previous week, which, by the way, was a second weekly decline. We have started this week on a weaker note as well. Well, the strength in US dollar, the weak China economic data, and the markets are now reacting to the China rate cuts that we have seen coming in. Well, this is to record lows that we've seen the LPR rates being cut to. The one-year loan prime rate has been cut by 10 basis points, and there also is a 7-day reverse repo rate, which has been declined to 1.7%. Some minor support in metals is what I'm looking at right now after that very sharp decline in the previous week. But since the China plenum meeting ended without anything, this is what perhaps could lead to some support coming in for the metal prices. When it comes to precious metals, well, the US dollar strength, the strong US jobless claims data, and the US Fed meeting on July 30th and 31st, ahead of that, we have seen declines come in for this one. So gold is trading at a 2-week low, silver at a 4-week lows, aluminum still holding around those 3-month lows. The markets are still reading into the China rate cut, and some reactions are anticipated during the day.
All right, Manisha, thank you very much for that. So that's basically what's happening as far as commodities are concerned. Gold in focus. Prakash Diwan is going to be joining us with some fundamental stock talk. Stay tuned. That's coming up.
Welcome back. You're tuned into Bazaar Morning Call. As promised, Prakash Diwan joins us to help us out with some fundamental analysis. Hi, Prakash. Morning and good to see you, Ben. We'll get to Reliance Industries in just a bit, but I wanted to understand, what do you make of the banking numbers? HDFC Bank as well as Kotak Mahindra Bank. For Kotak, we have a couple of downgrades as well. Your take on both those names?
Well, good morning, Nigel. So, absolutely. I think Kotak which clearly tell you there is bottoming out of on most parameters. None of the things that you would want a bank to kind of start showing improvement on have seen that, which means that there's and I mentioned this on the call with Abhishek on Saturday, that this is a bank that has consciously got out of lending growth, has been struggling with some sort of deposit growth, and the metrics now tell you that this consolidation that they've had internally, with the new management coming in, all the processes being reinvented, revisited, this probably seems like a consolidation and a bottoming out phase. Hopefully, they'll get some new energy to build into this thing. And they've spoken about branch expansion, the need to kind of raise deposits much faster. So I think the bank will have to do much more, because in the absence of some of the key portfolio growth areas like personal loans and all, and of course, the RBI wrap on the knuckles on some of the areas, there will be some time before this takes off. So it's going to be sideways. I don't think the market's going to like these numbers or the commentary, with any immediate effect. HDFC Bank, on the other hand, does show some sign of getting its act together on some of the parameters, the CD ratios that everybody's got worried. So I think that's where the growth will happen. In spite of all of the constraints, they've done some sort of credit growth, which is nice. But going forward, and remember, this is a quarter which usually is quite challenging for HDFC Bank and most banks. So I think going forward, post-monsoon, the season could, the cyclical nature of the business could probably help them. But I'm not very worried about the HDFC Bank numbers, though people have been talking about flat growth and all of that. But Nigel, I think it's a Kotak Bank numbers which will probably take center stage with a disappointing set coming through. But then, of course, the market's not in the mood to reward anything which is less than expected. So you'll see negativity on both. Yes, on issue.
Okay. I want to ask you about Reliance as well, but we do have a couple of more guests joining us, so we'll do all of that together. In the meantime, Prakash, your thoughts on Indian hotels, because it was seasonally a weak quarter, right? Where there was this heat wave, the wedding dates were on the lower side, etc. So that hit the numbers. But largely, Indian hotels has been a big wealth creator. Do you think that the prudent thing to do would be to buy the dip, or are you cautious here?
Good morning, Sonia. No, absolutely. I think hotels is an area which most investors I see in the portfolios are underinvested. And if you had to kind of start looking at getting some exposure, there's no better name than this. And as a matter of disclosure, I do have this in my long-term portfolio. Indian hotels will, actually lead the performance, and it will outperform the market growth go along, given the kind of properties that they sit on, the kind of growth plans that they have. And, so while we speak about trying to kind of do its bit and all of that, Indian Hotels already has a right to win in most locations. And once the traffic comes back, once, the seasonality is out, you'll probably see the numbers catch up. And what's improved in this quarter as well, like certain other quarters, is the efficiency ratio. So I think the utilization levels, the kind of cost management that they've been trying to bring in, all of that does reflect in these numbers on there. So yes, you're right. If the market gives you that opportunity, please check into Indian hotels for the long term.
Prakash, hi, morning. Broader markets really hammered, right, on Friday. This morning as well, GIFT Nifty is indicating a lower start, at least on the Nifty. Just a quick word on, the big driver. There was also those comments from SEBI chief. So it's a mix of things. It's always a mix of things coming together. I think it's very clear now, some regulations in F&O are coming. It could come, I think, right after the budget, perhaps something as early as this week. But what's your sense on, just a quick word on the market, but also on these market intermediary stocks? You've got exchange listed and you've got a bunch of brokers, etc.
No, absolutely, Prashant. There's lots that's happened over the weekend. But, the market today might give you a little bit of a weak start thanks to some of the heavyweights, the Nifty constituents, not in great shape in terms of the results and all. So, for example, out of your top 10 stocks, 5 are in the red. And most of them happen to be the large ones. So that's one thing. But what happened on Friday, if you ask me, was actually a very clear lightening of positions before you go into budget. And secondly, there's a lot of profit booking in sectors which seem to be a bit overheated, and there's rotation in other sectors. So while all this happened, the advanced decline ratio was fairly decent. It wasn't really out of whack, where it was only declines and no advances. So it was almost equal, which tells you that there are certain stocks where the buildup is still happening, but the sectors could probably be still not being discussed as much. On all these regulatory things, I think it's very valid. It's required. There's a lot of speculative element that's come into the market rather than focus on core investing ideology. But remember, F&O and small cap really don't have much of a correlation. I mean, you could see volumes go down in F&O, but that's got nothing to do with this thing. So I think it's more of profit booking, sector rotation at work, and we'll probably see continuation of that today as well. So till the budget throws up new opportunities, probably people are wanting to sit on cash and be ready.
Okay, now let's talk about Reliance, right? So we have two gentlemen joining us to decode the numbers and how you should approach the stock. So Prakash, stay on. We also have Prabal Sen, the energy analyst at ICICI Securities, and Balaji Subramaniam, the vice president at IIFL Securities. Gentlemen, morning to all of you. Prabal, let me start with you because, the oil to chemicals business was on the weaker side. As expected, the macros have been weak. Given all of that, what was your reaction to the earnings and what do you see as the impact overall on the stock?
I think as far as OTC is concerned, what was very evident was that even the outlook that was presented by the management seemed a bit more cautious than it has been in the last couple of quarters. So more than the weakness in the numbers this quarter, my clear sense is that FY25 numbers will probably look a bit weaker than what, I think earlier expectations were. So that is clearly the first, takeaway from the way that the results came through. The second thing is that if you look at the upstream segment as well, with the segment hitting its peak production of close to 30 MMSCMD now, and the investment multiple, I presume, has gone over the threshold level at which the share of government in the profit petroleum starts to rise disproportionately. Now, this can reverse if they bring newer assets into play or newer asset development plays into play where higher capex is once again allowed. But once again, FY25 at least, the upstream share will also start to, decline compared to FY24 because the government share will go up for this period. Thirdly, as far as retail is concerned, again, there was a slightly disappointing number, at least with respect to our and street estimates. So one will have to see how the momentum picks up. Geo remains the one bright spot with the tariff increases that have already been done. So on an overall basis, I think 25 consolidated earnings definitely look a tad weaker, and we have downgraded numbers by about 5 to 6% for 25 in our results note. And I think that is something that fairly sort of represents what has gone on and what we look at the macro going forward for the next 12 months.
Okay, so you're saying that FY25 will look weaker because of the management's guidance, and you've gone ahead and downgraded your estimates. Balaji Subramaniam is still with us, as well. Balaji, your thoughts on the numbers? There is this EBITDA, there's expectation of an EBITDA up move because of the tariff hikes that, Prabal was also talking about. And going ahead in Q2, there's expectation of stronger refining margins compared to Q1. But overall, what's your view on, the earnings, and in terms of Geo particularly, what kind of growth are we looking at?
Good morning. Thanks for having me on the show. As far as Geo numbers were concerned, they were largely in line. But one can see that, two takeaways for me would be, one is that ARPU has been flat for the last 3 quarters or so. And that is because, whatever higher usage is happening in terms of 5G, that is not showing up in the numbers because of 5G having unlimited data usage plans. And I think, unlike say Bharti, which has the factor of 2G conversion to 4G still going on. In Geo's case, since all customers are on 4G, the ARPU has kind of flatlined. That said, I think in that sense, against this backdrop, the tariff hike will come as a much needed ARPU and revenue booster. And we should see some bit of the revenue uptick from the tariff hikes to come in 2Q itself, and in 3Q we will have almost the full impact of the tariff hikes coming in, and that is when one can expect the ARPU to cross the 200 level. And the other thing in terms of these results were that the S&D expenses also seem to have climbed a fair bit. That is probably because of the higher competitive intensity that is happening in the marketplace, especially as far as subscriber acquisition and MNP is concerned. Now that we have Vodafone, who is strongly defending its turf, we may see that also persisting in the near term. But that said, I think the fairly healthy tariff increase should mean that the revenue boost from that should mostly offset any increase in the S&D costs.
So I heard you mention briefly a 200 rupee ARPU. I mean, for the last, I think, 10 quarters, the ARPUs have been between 175 and in this quarter, okay, we've gone to almost about 182, right? So for the rest of the fiscal, what are you looking at for the average revenue per user? And how much of it do you think is priced in? I mean, I didn't get your view on the stock per se.
See, I think almost all telecom stocks, including Reliance for that matter, prices in a significant, ARPU improvement. So my own ARPU estimate is around 201 for fiscal 25. But that also means that the 3Q and 4Q ARPU will be higher than 200 because we are also including the first quarter where the ARPU was just 182. So I would expect the ARPU to comfortably clear the 200 rupee mark by the second half of this fiscal, because if you see, even if we assume that out of the 20% odd tariff hikes that they have done, even if 15% is what gets retained, then we are looking at an ARPU of somewhere in the 207, 208 mark by 4Q of this year.
Okay, so by 4Q of this year, you're saying 207, 208 is what the average revenue per user could look like. Got it. Thanks a lot for that, Prabal and Balaji. Thanks for joining in. Prakash Diwan is also with us. Prakash, of course, we discussed Reliance at length on Friday when the numbers came, but very quickly, on the stock itself, do you expect weakness? And if yes, would you use that as an opportunity to buy?
So, Sonia, as I mentioned, most of these numbers might seem disappointing, but then there was a lot of expectation that there would be softness, and they're exactly in line with that. In fact, the Jio numbers will probably start improving very dramatically, as Balaji was sharing. My sense is, if there's a dip, and there could be, most likely, you buy into Reliance with a view on the other optionality, which is Jio, retail growing, demerging, and of course the new energy business, hydrogen business. So the green hydrogen business we've not spoken about, but that's building up very rapidly, and at some point you'll have to factor that in. So I would definitely recommend this from a long-term perspective.
Okay, let's take a quick break on that note. Thanks, Prakash, for that. On the other side, we have a market to trade as well. So Mitesh Thakkar and Sudarshan Sukhani will join in to give us some technical trades. Stay tuned.
Welcome back. Well, we've got the market pre-open kicking off in about 4 minutes or so. Mitesh Thakkar and Sudarshan Sukhani are with us with what they'd want you to do as we kick off another session. Gentlemen, good morning. Good to have both of you here. Mitesh, just a quick word on the index first. The GIFT Nifty is indicating a cut once again. Friday, of course, was a hammering for the broader markets. Nifty is not broken its 20-day, but the other indices all have, Mitesh. So what would you recommend?
Prashant, on Friday also I was suggesting people to exit because, of two reasons. One, the hourly and the 2-hourly charts were extremely overbought and the indicators had started turning south, suggesting some profit booking kind of a movement could happen. Now, on the Nifty, I think the first level which I'm watching is close to about 24,300 to 80 zones. I think that's very important support seeking. So we're still, after the gap down, could still have some more decline. And if that breaks at 24,100, so I think the market does look like, it will go into some kind of a pullback. Whether this turns into a big decline will be, I think, event specific. I think we'll wait for the budget to figure that out. But in the short term, it does look heavy and does look like, possibly some more profit booking will happen.
Okay, some more profit booking will happen. Got it. Sudarshan Sukhani is also with us. Sudarshan, if there is more profit booking, at what point do you think the Nifty deserves a buy?
Yeah, good morning. Well, Sonia, see, what happens is that tomorrow is a big news event day. Yes. So there is no sense in trying to anticipate the market action and look at a level today to buy. I would have said we should buy on any 100-point dip today. But because of the news event, it's not worth it. We should wait patiently for the budget to be announced and for the market reaction to set in. If the market is willing to go higher, that's the point tomorrow when we should buy. Even if we have to buy 100 points higher, that would be better.
Okay, let's do one thing. Let's take a short commercial break. On the other side of the break, we'll continue our discussion with the guests and we'll get you some, some stock-specific cues as well. Apart from that, Sanjay Lodha of NetWeb Technologies will be with us to put focus on their Q1 earnings. Stay tuned. Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. We're heading into a brand new day, a day that could be, filled with a lot of red on the screen. So let's get our guests on board, Mitesh Thakkar and Sudarshan Sukhani, to tell us how to approach it. Sudarshan, in terms of individual stocks, what do you do now, especially with names like Reliance, HDFC Bank that could come in perhaps for profit taking? And what does your list look like today?
Well, if you're a positional trader trading for a few weeks and forget about investing, then you want to buy Reliance and HDFC Bank both. I would think they will be much higher than current prices, whatever they get today after 3 months. My own list is mixed, buying and selling both. Bajaj Finserv is a buy with a stop under 1590. Page Industries is a buy with a stop under 39,500. I have two intraday shorts, Exide, stop above 570, and Laurus Labs, stop above 460. So it's a mixed list.
Okay, got that. Thanks for that, Sudarshan. Mitesh, what about you?
I have more of sell calls today. Bharat Forge is a sell with a stop at 1610 for targets of 1505. Sell on NMDC, which I would recommend selling with a stop at 234 for a target of 215. And a conditional sell on Godrej Properties. If it breaks 32.13, it might do that in the opening trade itself. Then sell with a stop at 32.80 and look for a target of 31.10. And one buy call, that's HUL on a mild dip around 27.15.20, buy with a stop at 26.85 for targets of 27.80.
Okay, all right. We'll come back to you for more trades in a bit from now. The rupee is open. Rupee, by the way, I was pointing out earlier, on Friday hit a new all-time low as compared to the dollar. I mean, it was a sharp correction. The Nifty is now settling about 100 points down. And I think you've got this, the sensex, which is coming up with some cuts as well, but nothing very large. So finding its feet, we'll kind of pick up from there. But we have a company at hand. Netweb Technologies is the company we're speaking with. They reported a strong set for the first quarter. Revenues and profit after tax was up 150 and 200% respectively. You know, we've heard about Netweb Technologies. We've had sort of portfolio managers coming on and talking about how Netweb is a strong play on the data center build-out that India will see. We have Sanjay Lodha, Chairman and Managing Director at the company, joining us now to take some questions. Sanjay, good morning. Good to have you with us here. Thank you very much for your time. Prashant this side. I mean, so, you know, we'll come to that opportunity on data centers, etc. in just a bit. But just numbers, 40% growth. You've been growing at 40% CAGR for the last 2-3 years. Can you continue with this kind of growth in FY25 as well?
Yeah, actually, basically, we have been guiding actually 35 to 40% of growth, actually, approximately. Last year also we did it. And every quarter, whatever we indicated, whatever we guided, we were able to overachieve that. And basically that kind of momentum I could see actually in the market. And this is the kind of growth we are not seeing basically in 1 quarter or 2 quarters. We have been witnessing it for last approximately three plus years. And we hope that this journey is going to go on. Because, you know, basically the tailwinds are really excellent. You see, basically, I have never seen the data center market, the data center demand in the country growing as fast as it is growing at this point of time. Basically, there is a breadth of data center space. There used to be time 2-3 years back when basically data centers were really struggling to get with their space filled up. But today, basically, new data centers are coming up. And data center definitely is booming. So definitely the private cloud market is blooming. What has happened is that previously the data center was primarily based on more bare metal and all that. But now data center has evolved. And data center requires basically private cloud kind of a thing. And plus the kind of GPU compute, which is really pacing up very, very well. I think all those factors are really boosting the data center growth. And I feel this is happening.
Sorry to interrupt. How much of your end use market is data centers? Is all of it data centers? And so in a way, you're tied at the hip to the growth on that market. I think data center capacity now is about 1,000 megawatt in India. I was looking at projections. It's expected to go up to about 1,700 megawatts by the end of next year, by some estimates. So just your thoughts. I mean, end use for you, how much is data centers?
So basically what happens is that if you see my business is primarily split into 3 major segments. First is the supercomputing, actually. That is the HPC, high performance computing. That primarily, moreover, goes into the government segment. That is around 50% of my business. And 50% of my business is from enterprise. So basically the 3 segments which we work in is, one is supercomputing, second is private cloud, third is AI, and basically AI and AI workstations. So basically, if you really see the HPC part of it is somewhere around 35% of my business. Around 35% of my business comes from the private cloud. So this private cloud piece clearly goes into the data center, because basically the enterprise customers and the large customers, basically primarily most of this goes into the data center.
Okay, all right. Hi, Mr. Lodha. Good morning and good to see you win. A couple of questions. For this year as well, you're telling us that you've grown at 35-40%. We've got that. So for this year as well, will you grow at 40% or will it more than that? And since you mentioned AI systems, I think it's risen from around 7% of your total mix, closer to around 15% of your mix. Where does this number head to?
Yeah, so basically, I will still be guiding you around 30 to 35% growth only, as we have been doing it earlier. Because basically, this industry is basically we can predict. And if you see my order book, that was around 400 crores in March. And again, my order book is again for around basically similar number again now, even though basically after registering of around 143% kind of a growth approximately. So basically that gives me a very, very confident feeling that I'll be definitely achieving the 30 to 35% growth which we have indicated very clearly. As regards AI systems is concerned, you know, we are one of the OEMs which are basically which is basically signed up directly with NVIDIA, wherein we are manufacturing systems based on their latest architectures and all. So definitely we are seeing a lot of traction around it. And you can see it in my numbers also that it was basically last year, it was around 7% during this period. It has risen to around 15%. So that is definitely AI systems is again boosting the growth further. And we are very sure that this will keep on boosting further in the future.
Sure. Do you have any acquisitions that you're looking at? Because you have mentioned in the past that you're looking at some strategic acquisitions, but I think you're not closed in on a timeline. Any update that you can give us?
Yeah, so basically the acquisitions, we don't want a general acquisition. We want basically, rather than, you know, we have a very strong R&D team, which was around 54 people while we went for an IPO. It is now around 70, 75 people now. So basically, we are looking for some kind of strategic acquisitions in the domain we work. We are still talking to some people. There are some discussions which are happening, but I think you will have to wait for more quarters so as to have a firm news on that.
So just a very basic question, and apologies for that, but you know, in all these segments, so this is all equipment, right, that you are supplying for all these end markets, hardware.
Yeah, so I will tell you, basically, basically our mix is very different. That makes us basically very different, and wherein you find it very difficult to find peers for us. We are basically, we design our hardware, we manufacture our hardware. This quarter, basically, we inaugurated our state-of-art facility, the new server manufacturing facility, which is one of its kind in the country today. And it was inaugurated by none other than IT Secretary himself. So basically, that was done on 10th of May. So we design our complete systems, our motherboards and everything. We do our manufacturing, and we have our own software stack. We don't sell boxes at all. So basically the focus is really not selling boxes at all. Our focus from the very beginning has been to sell complete solutions. And I think that creates a differentiator for us. So basically it's not only the hardware, it's the hardware plus the software. So we sell it in an appliance mode, like basically for supercomputing also, same way for private cloud and HCI, and same way for AI systems. We have our own software stack, which we bundle along with our equipment and sell it. We don't sell our software separately, and we don't sell our hardware separately.
So this is in terms of, so this is a one-time sale, or is there a annuity kind of business as well for maintenance, etc.?
So basically,
that revenue which trails. Yeah.
Again, there's a very unique factor in this. This is basically one-time sale to the customer. But you know, most of our customers are enterprise customers and high-end government customers, and the technology life cycle changes within 18 months approximately. So basically, within 3 to 5 years, the customer comes back to us for a refresh. So rather than targeting annuity revenue, we target the revenue, the repeat revenue from them. If you see my strategic presentation and all those things very clearly, the repeat business from the customers is pretty high.
All right, we'll leave it there. Thank you very much. Appreciate you joining in, Sanjay. Great speaking, and thanks for joining us. So that's the management of Netweb Technologies. There's 5 minutes to go for the market opening. The pre-open is I think left us with some cuts, and it's on your screen now. 85 points lower on that one. But some 9-10 calls with the pre-open rates also visible now. Mitesh and Sudarshan are back with us. Sudarshan, what do you have?
Buy Bajaj Finserv with a stop under 1590.
Okay, and Mitesh, what about you?
I'll choose a sell on NMDC for targets of 215.
Okay, sell on NMDC. By the way, the pre-opening rates have settled lower, so just brace yourself for that. The stock of the moment on the downside is Wipro. Remember, the numbers were quite weak, and you've had the guidance. The guidance has been muted for Wipro as well. So it's a multi-quarter low in terms of, there is I think the 6th straight quarter of a revenue contraction that Wipro has seen. So the street definitely doesn't like that. Reliance is the other one that's down about 1% post its numbers. Most large caps actually. HUL comes out with numbers this week. So ahead of that, it's down about 1%. On the upside, HDFC Bank is holding up a tad bit, but Abhishek is here to tell us about Can Fin Homes and Kotak Mahindra Bank. Abhishek, over to you.
Well, both of them disappointed. So, Can Fin Homes disbursements have declined by 15% quarter-on-quarter. The AUM growth is at just 9.5% on a YY basis, which is the lowest growth that you are seeing in last 12 quarters. Net interest margin is at 4-quarter low as well, coming in at 3.57% versus 3.96% in the previous quarter. So, sharp contraction over there. Asset quality has deteriorated. Gross NPA in absolute value has increased 13.6% on a sequential basis. Net NPA is up 18% on a sequential basis. Coming on to Kotak Mahindra Bank, net interest margin has come in at 8-quarter low, despite the fact that credit deposit ratio has improved. So NIM is at 5.02%, a decline of about 26 basis point sequentially and about 50-55 basis point on a YOY basis. Deposit growth is at just 15.8% YOY and down about 0.3% sequentially. YOY, it's the lowest growth that you are seeing in last 6 quarters, and sequentially it's declined for the first time in last 16 quarters. Advances growth at 18.7% is perhaps one of the best in last 6 quarters. Operating profit growth was just 6% on a YOY basis, perhaps the weakest that you are seeing in last 8 quarters. Provisions increased sharply by 59% YOY and about 119% sequentially. So their NII was below our poll, and due to one exceptional gain this time around, PAT has beaten our poll. Back to you.
Okay, thanks for that, Abhishek. Well, let's hop across to Manglam. He's here to tell us about ITC, which has been one of the biggest gainers in the last month or so. Manglam.
Well, you know, one day ahead of the budget, Macquarie has actually gone ahead and initiated coverage on ITC with an outperform rating and a target price of 535 rupees. They say that while the cigarette business of the company has headroom to grow, it's the stronger pace of growth in their non-tobacco portfolio that makes them a lot more positive. So they expect the EBIT contribution from non-tobacco, which is currently under 20%, to be around 35 to 40% over the next 10 years. In fact, they factor in 11% EPS CAGR over the next couple of years as well. And they're valuing the non-cigarette business for FMCG business at around 45 times and the cigarette business at around 20 times 1 year forward price to earnings as well. For them, the key catalyst going forward after the demerger of the hotel business would be the demerger of the FMCG business and rational cigarette taxation. One of those, which is rational cigarette taxation, is something that we'll get some clarity on tomorrow itself.
Okay, thanks a lot for that. Well, Reliance is also in focus. Let me quickly take you through what brokerages have made of the numbers. Remember, it's been a mixed bag for Reliance this time around. The oil to chemicals business has been quite weak, so that could reflect on the stock. Jio was also under a bit of pressure as per some brokerages, while retail was steady. The stock is down about 1%. Nomura says it was an in-line quarter. They reiterated a buy with a higher target price of 3,600 on the stock. They say Reliance is their top pick in the sector at the moment. Jeffrey says revenues missed estimates. It was a weak subscriber addition for Reliance Jio. Macquarie says Q1 was a material miss due to lower than forecasted Jio and oil to chemicals business. They continue to see a downside risk to consensus estimates, and they maintain a neutral on Reliance with a 12-month target price of 27.50. Standard disclaimer, Reliance Industries is the owner of the channel that you're watching, and little bit of pressure is what you're seeing on the stock as we head into a brand new day of trading.
Absolutely, and we'll track the opening in just a bit for you. Just a few seconds to go for market opening. Lots to track. It's going to be, the color is a bit red, nothing deep. Friday, of course, was pretty poor for the entire market, broader markets especially. And here we go. First trades, 0.5% lower, 24,410 or so is where we are starting. 394, a little over 0.5% now. Sensex is down about 0.4%, 80,296. Nifty Bank starts about 0.5% down. We're at about 52,000, 51,989, 52,000, just sort of blinking up and under and above that number. Mid-cap index is down a little more, so 0.75% down in the Nifty mid-cap index. Both mid and small cap indices sold off 2% on Friday. Market breadth is negative, but I mean, it's not like one way. 1,200 down and about 730 stocks higher. That's essentially the lay of the land as far as the opening levels are concerned. But this is a negative start, lower start. All about stocks, so let's get to it.
Prashant, the biggest loser right now is Wipro. Just pull that stock up. It's almost 8% knocked down on Wipro. And as we were telling you, the earnings were a miss. The guidance was muted. It is the 6th consecutive quarter of a revenue contraction. And actually, Hormuz very helpfully tells me that it was a 6.5%, I mean, this 8% drop for Wipro is the most that we've seen since October of 2022. So, so that's one stock to focus on. Apart from that, HDFC Bank, let's take a look at how that one is shaping up this morning, post its numbers. HDFC Bank, okay, just holding out on the green line. But there is a downgrade from JP Morgan this morning on HDFC Bank, so keep that in mind. Reliance is the other one that's really dragging its feet this morning, down about 2.5% post its numbers. As I was saying, the weakness in the oil to chemicals business is, the one that is causing all this pressure. Then you have Kotak Mahindra Bank, disappointing earnings, net interest margins declined to an 8-quarter low. So keep an eye out on Kotak Mahindra Bank. Indian Hotels, Canfin Homes, a couple of other stocks that are reacting to their numbers. For Indian Hotels, it was a seasonally weak quarter, but it's been a stock that has, delivered returns to shareholders. So there's some, some buying interest there. Canfin Homes is the other one that is under a bit of pressure right now, down almost about 3.5 to 4%. So lots of stock-specific reactions at the moment, but I think Reliance is the one that stands out, apart from Wipro, which is the big loser.
Well, that's right. From the broader markets, Yes Bank, that's a stock that's opened up with a gain of close to around 4%. Lower provisions aided the profitability. The slippage ratio is elevated, but at a 7-quarter low. So Yes Bank is one of the stocks that's doing well from the broader markets. RBL Bank as well. The first tick was in the green. Volumes are fairly high on that one as well. So pointing out both those two. Navkar Corp, well, that stock opened up well in the green. There was a large trade that took place on Friday. Stallion Asset had bought more than 1% stake in the company from the open market. So that could explain why there is some excitement on Navkar Corp. That was one of the top gainers. Should come up for you on the screen. Kirloskar Pneumatic, well, the revenues grew by close to 14% on a year-on-year basis. However, on a sequential basis, they were down by more than 40%. That's because of a delay in project execution. So explains why Kirloskar Pneumatic, that stock is a little bit low. And Anand Raj, big uptick is what we're seeing on that name. Opens up, I think, with a gain of close to around 4%. So a sharp move is what we're seeing on the upside on Anand Raj. I think there was, it signed an MOU with Google for their data center business. So that is the reason why that stock is up and about. But as we took that market check, well, we pulled back a little bit from the low of the day. I think the good news was we're at least holding on to the 24,400 odd mark. Prashant.
No, absolutely. And, lots happening across the board. Yes and RBL are the two sort of banking stocks which have got the most in terms of gains and volumes right now, 2% and 3% respectively. There is, MTNL just been rising. I mean, 73 rupees now, 5%. It's got large, is the third largest volume traded stock. Look at that, some 12 million shares, 12.6 million shares. TTML, by the way, is the top volume traded name now, 107 rupees. It's up 5%. It's just rising on volumes. That is Tartali Maharashtra, TTML. You've got, what else? Oberoi Realty, which is up 4%. A few other names. So stocks at about, 1740 on Oberoi Realty on your screen. Large volumes. Anantraj is up 4%, 500 plus on Anantraj. Just Dial had a very large move. I think it was on Thursday. 2% on Just Dial. Shakti Pumps is back up 5%, closer to 4,100 once again. Many of these stocks have had whipsaws on the way down and then sort of recoveries now. But it's a quieter kind of session. Quick Heal had a big move, I think, one of these days last week. It's up about 4% right now. Actually, I think Quick Heal had a good week overall last one. SJS is up 10% on some volumes. HG Infra is starting ends. Nitin Spinners has got about 7%. But that's essentially the bulk of what's rising on some decent-sized volumes. On the downside as well, there is Bharat Dynamics, defense name, 3% lower. Tejas Network is down about 6.5%, 13.18 on Tejas Network on large volumes for now. Apar Industries is down about 5%. There is Canfin Homes, which is down about 3.5%. Credit Access, and you will just hear from the management in just a bit. Credit Access is down 5%, 12.23 on that name. Root Mobile is down 4, Anand Rathi is down 4, Raymond is down 5, and I could go on with a few more names, but more down than up, clearly. 400 stocks are higher, and you've got about almost 1,800 stocks which are starting the day down and out. Devina Mehra is now joining us. She's the market master for the day, founder, chairperson, and managing director at First Global. Devina, good morning. Great to have you with us here on the program. Prashant this side. It's always a pleasure. Devina, markets have done phenomenally well. Nifty is up 12% from the 4th of June close, the election day. Mid caps and small caps even better. And now we get into the budget. And we also are, of course, not hearing, but the SEBI chief has made it very clear that on the F&O side, there are rules and regulations coming to tighten it. Where do we find ourselves in terms of markets? I'm talking slightly near term, not very long term, but not very short term as well, but shorter term. Devina.
Good morning, Prashant. I mean, a very short term is not something that I look at all, and even reasonably short term is not where my focus is. So, as I have spoken earlier on your channel as well, that on a 1-2 year basis, I am not negative on the market, and primarily because you had a whole decade of below market returns. 2010-20, that decade was so far below market expected market returns of 15-16%. It wasn't even 9%. It was pretty close to the FD rate for a whole decade. So 100 rupees in 10 years became only 230 rupees. And which is very different from what happened in the other decades. Of course, the outlier was the 1980s decade when 100 rupees became 700. So that's what gave you the room to grow. So, I mean, the way we have done it is that we are fully invested in our PMS, but we are partly hedged. Before the elections, we were fully hedged. Now also we are about 50% hedged. To take care of any interim volatility, but I'm not negative on the markets. Even if we just finished our rebalance last week, we do a quarterly base zero rebalance. So there have been changes in the portfolio, but we are not negative on markets as a whole. But as I have warned again many times, be very, very careful on the small and micro caps. So in our portfolios also, while we normally used to have about maybe 14-15% investment in stocks between in 1,000 to 5,000 crore market cap. Now we are down to I think 6% or thereabouts. So that's because that's a area which you cannot manage risk effectively, because there are two tools primarily of risk management. One is stop losses, and stop losses don't work in small caps. When they go down, it's circuit down every day. And the only other hedge you can use, which is liquid, is a nifty put, which again does not move in sync with the small cap. So that's where a lot of people watching this may have made a lot of money. Now is the time to go into a steadier portfolio. That would be my advice.
Okay, Devina, hi. Always great speaking with you, and good to see you this morning in your bright attire, brightening our mood for sure. But is there anything in the budget, Devina, that can change the course of the market? I mean, I know every time we speak about it because that's our job, but generally budgets don't really affect the texture of the market in the near to medium term. Do you think this budget would be any different?
I don't think so. I mean, of course, there can be a macro change, like there can be a change in something to do with taxation, for example, either direct or indirect, which affects things across the board. That's one thing, but I don't think there will be a change in corporate tax this time. That's not what I'm expecting at all. So probably not. If there's a change on the personal income tax side, it boosts consumption, which definitely needs a boost. We've had very poor consumption growth numbers. Other than that, if there is specific changes in specific industries that, for example, there are industries where the GST is higher than 18%. If, let us say, two-wheelers, it comes down or something like that, that can impact directly that industry. But other than that, I do not see a budget to be a great event, and it should not be. I mean, in most countries, budget is not the event it is in India.
All right. Hi, Devina. Good morning and good to hear your thoughts. Devina, the last time we chatted, you were telling us that IT could bottom out at some time during this year. It seems the street is calling for that, going by the numbers that we had. How are you all placed on tech?
Yes, so IT is where we were slightly overweight going into this rebalance, and now we are a little more overweight. Yes, so our systems are showing that it has probably bottomed out. And the other thing which I had spoken about was that whether industrials and capital goods, that segment will top out. So that signal has not come. So we've been overweight on that sector, as I have said earlier, also since October 21. So it's getting close to 3 years. We are no longer, of course, very highly overweight, but we continue to be a little overweight. And of course, there have been some changes in stocks in that sector. but we still remain somewhat overweight there too.
Okay, you're a little wary of some banks as well, and that was the reason why you were not going overweight on banks, though consensus was saying that banks are in for a good run. That's not really played out. Now, how are you all positioned on the banking names going by the numbers that we have had and the commentary as well that's coming in?
So, I mean, on banks, if you look at 4 years from 2020 onwards, banks have underperformed every single year barring 2022. Every single year. All other 3 years, banks, you look at Bank Nifty versus Nifty, Bank Nifty was a huge underperformer in spite of the run in the PSU banks. And as I have said plenty of times, that I am a nervous investor in non-lenders. We remain underweight banks, though. I mean, I would think that given a long stretch of underperformance, probably that, that grave underperformance period might be a little behind you. This time, the changes we have made, while our overall weight in banking has not changed much, we have moved out of some PSU banks and added some private sector banks. So that's a change. Interestingly, this time our systems did not like all the non-lending financials that we were holding, the asset management companies, the stock exchanges, and anything related to the market. It downgraded every single one. So we are more or less out of that segment. So that was an interesting thing in this rebalance.
Devina, so one thing which you've pretty clear about is that one should rebalance the portfolio if not one has already not done it. Made a lot of money in mid caps, small caps, micro caps. So your advice is take profits if you're doing it yourself and move to slightly larger larger companies and large caps in that sense. So is it possible we perhaps could look at the most common argument which is thrown at anyone who says, well, maybe one should do that, or maybe we are in for a phase of consolidation or sideways market is, of course, there is a huge recency effect because every time people have called for it, markets have continued to run ahead. And this number two is, of course, liquidity, which is all real. If you get the numbers every month, it's just a big gush. So just your sense, Devina, what we should expect in that sense. Are we, is there going to be a time period where earnings will have to grow into prices, especially in the broader market?
Talking of liquidity, for one, I'm never a votary of that. If money comes, the market goes up. It doesn't show up that way. But more than that, if you look at the recent months and quarters, most of the money has come in certain themes, where it was small caps, it was defense funds, it was these kind of themes. And if you look at the history of thematic schemes from mutual funds, where the history is there for a long time, they always come near the peak of that cycle, which is not surprising because, after a segment has done well, whether it's an industry, whether it is small cap, whatever, is when the layperson knows about it. So they go and put money in that theme. But if that theme has to crash, it crashes. So, I remember last year someone told me that, ma'am, you keep talking about against thematic funds, but here is this technology fund, which was 2 rupees in 2003, and in 20 years it has compounded X times. And I said, very good. So it was 2 rupees in 2003. Did you see when it was launched? And it was launched exactly 1 week before the tech crash. So in 2 years, it had gone from 10 rupees to 2 rupees. And now you're telling me the compounding from 2 rupees. So be very wary of buying into any theme which has already run up, which is primarily all the new fund offerings that come are in themes which have already run up. So in 2021, I was warning same thing about NASDAQ ETFs and NASDAQ ETFs and funds being launched in India, saying this is also recency bias. NASDAQ has done brilliantly for 3 years. It won't last forever. And sure enough, it fell 40% from those peak. And some people compounded a bad buy with a bad sell by also selling at that 40% down. So be very wary of themes which have already run up and do not fall for this that someone was telling me, but there will be unlimited money chasing limited number of stocks. And I really laughed. I said, for 30 years, I have seen this argument. It never works. The stocks which were darlings and everybody was waiting to buy them still will crash if the fundamentals don't hold up.
Absolutely, absolutely. That's a fair point. Devina, always good speaking with you. Thank you for joining in. And tomorrow is a big day. It's the union budget. Hopefully, we'll speak to you post that as well to get your sense on how to approach the markets from here. But always good speaking to you and seeing you this morning. Thanks for joining in.
Thank you.
Okay, well, that's the word on the markets, which, by the way, is not bad. It's actually pulling back. The dips are getting bought. The Nifty is not bad at all, down just about 0.3%. And as you can see, that early morning dip has gotten bought. The market perhaps is sanguine about something, maybe to do with the budget. But there are individual stocks which are still under pressure. Credit Access Grameen is the next management on the show. There is incremental stress in the portfolio, which has risen massively. The disbursals have declined 44% sequentially. To discuss this and more, we have Uday Kumar Hebbar, who is the MD of Credit Access Grameen. Mr. Hebbar, good morning and thanks for joining in. First, if you can tell us what's the outlook on the NPAs, because there is a lot of incremental stress in the portfolio. So can you give us some guidance on what asset quality could look like going forward? I mean, your gross NPA ratio is still around 1.5%. Do you think it can get worse before it gets better?
Good morning. Very happy to be here. So our credit cost is slightly increased. If you look at our guidance, we actually increased the credit cost guidance during the start of the year to 2.4%. Whereas again, today we are at net credit cost of 2.6%, considering some difficulty in the first quarter. But however, we would like to reiterate that our credit cost guidance of 2.2 to 2.4% will remain same. We will be able to manage within that. While we are talking about the increased credit cost, we need to note that our credit cost is based on stage 2 consideration at 15 days DPD and stage 3 considering at 60 days DPD, which means we have almost 116 bips higher provisioning as against our 90 days DPD. So which therefore it's a question of early recognition of risks actually. So we estimated little higher risk compared to last year and guided accordingly. So therefore, we would reiterate again that our credit cost will remain within 2.2 to 2.4%, which we guided for annual FY 24-25.
All right. Hi, good morning, Mr. Hebbar. Got that. So 2.4% odd is what we're talking about on credit costs. Give us a sense about the AUM growth for the year. What are you looking at on a year-on-year basis? It's up by 20%. On a sequential basis, it's mildly lower. So tell us for this year and the next, what kind of growth are you looking at? And also the retail segment, their growth has been quite robust and it's moved up. As a percentage of your total mix, what do you see this book move to, the retail finance AUM?
Yeah. First quarter disbursement resonates normal, low or a muted first quarter always. So there is not too much variation between FY Q1 24 to Q1 25, which is muted. And when we always keep telling that whenever this election, there will be muted growth because of the operational difficulty during that period, or there are some limitations in due to code of conduct. That's common for the microfinance sector. Therefore, it resonates the first quarter syndrome. And while we're giving the guidance for the year, we guided 23-24% overall growth, whereas microfinance growth we guided as 20% as against 24.7% of FY24. We have actually reduced the guidance for microfinance growth, and overall our growth should be 23-24%, which we don't see any downside risk for that. Retail is definitely robust. We agree that we would be growing higher in retail because we have a large number of retained customers who are vintage customers, and this retail is nothing but giving the differential or what you call product which is needed for them, like two-wheeler loans, individual business loans, LAP or home for our vintage customers. Therefore, we have a large number of customers who out of 5 million, even 10% of if you convert, we have 15-20,000 crores potential portfolio in the next 4-5 years. Accordingly, we believe that retail should go as usual, and microfinance growth may taper down. This year, we estimated 20%. We are quite within that guidance, and we reiterate our guidance for the year on AUM growth.
Right. So thank you for joining us, Prashant here.
Hi, Prashant.
So on microfinance, sir, are you going slow, or is there sort of slower uptake of credit?
No, it's basically, as our base is increasing. We cannot keep growing at 25-30%. So therefore, we believe that it would taper down a bit. That's why our next 4 or 5 years of guidance, we actually said that microfinance is slowly tapered down by 1 or 2% per year, whereas retail will take that space. So therefore, we believe that it will still grow overall 23-25%, but microfinance would be about 20%, which is what we guided actually, and maybe 1% each year it may come down, considering the base is increasing continuously.
Mr. Hebar, one of the things we've heard from many in the industry is, rising leverage across the customer base for NBFCs, banking, everyone, right? And one of the ways it manifests is multiple loans that each good customer has. I mean, could you just tell us, how are you mitigating some of that risk?
Yeah, it looks like little higher leveraging, but you have to see from FY20 to FY24 or FY19, because there is a dip in the leverage, there is a dip in the GLP per customer, and increase after COVID. If you see from 1920 to today, it may be a 15% increase or a 14% increase. But because we are looking only 2 to 3 years, last 2 years after COVID, it looks little high leverage. So we don't see too much leverage in our industry. Also, growth is not very high. But yeah, little leverage is increasing. Number of loans also increasing. But we put an internal rule that we will not be the more than fourth lender. Maybe some states we may be only third lender. Now that even MFIN, the industry body, aligned with all the members, including the microfinance, the banks, SFBs, and NBFCs together, we decided that we will not be lending more than as a fourth lender. It should not be more than fourth lender. Overall leverage of the client should not be more than 2 lakh. So these are the guardrails MFIN as an association we put in. I think this should further help to strengthen and build resilience in the microfinance industry. This will help further.
Okay, all right. Mr. Hebar, just to reconfirm that number, the AUM growth for the year is 22 to 23%, right?
23 to 24%.
Okay, and retail finance moves to mid-teens as a percentage of your book in the coming years?
So it should be by 28, we estimate it should be about 15% of our overall book.
Got it. All right. What about the NIMs? We've got growth, credit cost, and tell us about NIMs. What's the guidance for that?
We guided about 12.6 to 12.9%. We should be within that. And this year we guided at about 12.6 to 12.9. We should be able to manage that. So we did the risk-based pricing at a district level. We identify the risks at district level. We provision we make at district level. So we align the pricing, the risk and provision all to a district and granular level, which helps us to manage the risk and price accordingly and provide accordingly.
Okay, well, thank you, Mr. Hebar, for joining in and talking about Credit Access Grameen. But JSW Steel is the next management on the show. It reported an in-line set of Q1 earnings. The top line was a beat on better realizations, but there was a small miss on margins. Nigel caught up with Jayant Acharya, the Joint Managing Director and CEO of JSW Steel, and began by asking him about the quarter gone by and how they see growth going ahead. Listen in.
As far as the prices are concerned, I think first on the raw material side, the raw material prices, as we had indicated, has dropped on coking coal by $23 odd. We expect a similar $23 to $28 drop, let's say, this quarter as well, which will flow into the cost in quarter 2. Iron ore prices have started softening in India in line with the international price as well. Some part of that will again flow through into quarter 2. So softer raw material prices will again support the margins. Steel prices in the month of June came down, while in the month of May there was an improvement internationally in India as well. But there were corrections in June by and large across geographies. And that resulted in some softer prices going forward into this quarter. We expect now the prices to remain range bound and margins to be supported through a softer cost structure.
Okay, all right. Let's get a couple of aspects then going, Mr. Acharya. As you said, input cost, you'll see some bit of benefit of roughly around $25 per ton. So that's good news. Steel prices you're expecting to hold steady. I'm looking at EBITDA per ton for the India operations. Let's talk about the India piece first. It appears that the India EBITDA per ton has improved by around 550 to 600 rupees per ton. Do you believe that the trajectory is upward now and we continue to see an improvement in the India EBITDA per ton?
Yeah. So I would just like to clarify one point here. This quarter, in quarter one, we had some one-offs. So we had an impact of almost close to 2,000 rupees on account of inventory devaluation and some other one-offs in the balance sheet, which will be, let's say, not reappearing again. That's one positive. Secondly, from an India EBITDA perspective, as we discussed, the raw material prices, the softer raw material prices will flow into Q2, and that will support your margin. From a product mix perspective, if you see JSW Steel, we have taken a lot of initiatives to improve the product mix, and that has given us an upside. So in spite of a softer steel price, we could actually take the Indian, let's say the Indian realizations up by about 550 odd rupees per ton. Going forward, we expect that prices will be range bound, but our efforts to continue to improve the value-added piece will continue. Last quarter, it was 64% of our total sales.
Okay, all right, 64%, got it. So that protects you all with regard to the steel prices. A quick word on the international business. That struggled in the past quarter. Do you expect a couple of more quarters of pain? If you could give us a sense on that. And since we're talking about the overseas business, also from India, you'll export steel, and that proportion came down to around 10%. Where do you see this number stabilizing at?
So from an India perspective, I think I would say that if you were to look at our past history, we have been in the range of about 10-15%. Last quarter, we went to 20% because there was a window of opportunity which we got for exports when people were stocking up before the summers. But however, the international prices in this quarter were muted. The demand also was softer, due to which we recalibrated our exports in favor of domestic market. The domestic market was very strong, and therefore we chose to put more tons into the domestic market, and therefore our sales YOY for domestic India operations went up by 14%, which is a very good number. The India operations delivered the highest quarter one sales ever. Driven by various sectors, like especially in the sustainable areas like renewable. We did the highest sale to renewable. We did the highest sale to packaging, which is the tin, which is replacing plastics. We did the highest sale to electrical steels segment, where the energy saving is very efficient, etc. So that helped the India operations quite a bit. As far as the US operations were concerned, I think there was a sharp fall in prices, which basically impacted the operation. The volume has been by and large stable, and we expect that going forward, we expect volumes to be reasonably at a similar level, but the outcome on prices is yet to be seen. Italian operations have been by and large stable in quarter four and quarter one.
Okay.
Going forward into quarter two, we expect that the Italian operations will remain stable to slightly better.
Okay, all right. What about the net debt number? It's holding at around 80,000 crores. You have a big capex plan as well. Does it move higher from here?
So, Nigel, this 80,000 crores, we actually allowed the debt to increase because we spent about 4,500 odd crores on capex. We paid about 228 odd crores for some of our mining areas where we were to start up the coking coal mines. So that is something which we wanted to do because we wanted to complete our expansion projects quickly. We also repaid about $300 million of acceptances, which is about 2,500 crores. So that basically resulted in the debt going up a bit, but and some working capital build-up, I would say, for the operations which are coming on stream. So from that perspective, the debt got built up, but I think it's well within the range, and as the working capital gets released, you will see an improvement in the ratio levels as well.
Got it.
The net debt to equity remains flat. I think it's still below 1.
Okay, all right. Are you looking at any inorganic growth? I need to ask you that question because Mr. Agarwal is saying that he's a seller, but he's a seller at more than $1 billion for 1 million tons of steel. Are you interested in that asset? And any movement on NMDC Steel? Last time you said that maybe post-election something could move. Have you heard anything?
So Nigel, on the first one, I think we remain interested in the mining assets, but not in the steel asset. In the second one, which is NMDC, we are hearing something from the media, which I think you are reading as well. We will wait for any official announcements to go ahead. We have anyway given our expression of interest, and we will see how it goes. On any other inorganic assets in India, no. Our interest on our mining areas in coal remains for prime hard coking coal, which, as we discussed last time, we continue to look for assets which make strategic sense for us.
All right, final question. What about the budget 2024? What do you expect?
So no, I think the good thing about post the elections, the government has now come back. We see a renewed interest and focus on the oncoming budget on 23rd. We expect that the infrastructure and capex spend which the government has been doing will continue. The focus on manufacturing and energy transition will continue. They may take some steps to improve consumptions and general welfare and social initiatives, which is good. On the specifically for the steel industry side, I think I would say that the Indian steel industry is really trying to come up to the National Steel Vision Policy and the vision of the Honorable Prime Minister to make in India and be self-reliant. A lot of capex is going into the creation of capacities. We should not allow, because India is growing at a very fast pace. The surplus steel, which is now finding its way into India, we should not allow that to happen. Rest of the countries have blocked it. India should take proactive measures quickly to see that this unfair trade does not take place.
All right, well, that's Mr. Acharya guiding for better times ahead. He's saying that steel prices will stay stable, but they'll get some benefit on the back of lower costs, and also calling in for some measures to protect the domestic steel industry. Well, time to move on then. Let's talk about Indian hotels. The stock is buzzing today despite a seasonally weak set of numbers in the last quarter that was impacted by elections and a heat wave. The MD and CEO, Mr. Puneet Chhatwal, spoke to CNBC. He said that he was positive on growth going ahead. He also gave an outlook on their expansion plans and on demand going ahead. Let's hear him out.
This was a good quarter, keeping into account that every 5 years when there is elections, there is a dip in the business. The international delegations don't come in. Everybody waits for the outcome of the elections. There is a code of conduct that is put in. There was extreme heat this year, and there was no one-off like the G20 last year. So keeping all that into account, I think showing a growth was a positive. But what is happening is that has created pent-up demand for the second quarter. And what we saw in the first 17, 18 days of July was like a 20% increase over July of last year. Our focus remains on the Indian subcontinent for all our brands.
All right. Well, that's the management of Indian hotels with some perspective. We'll take a quick commercial break here with news that markets have staged a very, very strong recovery. I mean, we're down only 20 points now. The Nifty will come up on your screen. And we're at 24,500 plus once again. Take a look at that. The sensex is down only 70 points. Nifty Bank is actually in the green. The mid-cap index is up 0.25%. And market breadth is completely flipped around. It was almost 4:1, four down as opposed to 1 up. And now you've got 1,400 stocks which are higher and about 1,000 stocks which are lower. So a sea change as far as the screen goes over the last 45 minutes or so. We'll take a break. We are back with the management of ICICI Lombard. Stay tuned, that's coming up.
Welcome back. Well, let's get straight to the next management on the show, which is ICICI Lombard. It reported a mixed set of numbers. To discuss what went on in the past quarter, what's the way ahead, we have the company's CFO and Chief Risk Officer, Mr. Gopal Balachandra, who joins us on the show. Hi, Gopal. Thanks a lot for joining in. Well, though the premium growth has been strong, your underwriting loss only increased by around 8%. So what's the strategy to improve the underwriting performance, and what could be the kind of improvement we expect on a sequential basis for the remainder of this fiscal?
Just to kind of refresh, I would only say that the more the businesses grow,
given the fact that the earnings, as you rightly mentioned, happens over the contract period of insurance, whereas the costs are front-loaded. So to that extent, when you look at it from an absolute underwriting outcome, in times of growth, obviously you'll obviously see that number slightly showing an elevated outcome, and that's exactly how it has played out even for us. But I think the larger thing that I would keep saying is a better number to look at is more the combined ratio outcome. And there, if you would have seen, let's say for Q1 of last year, we were at roughly at about 103.8 in that range. And the current quarter has been about 102.3%. And if you look at, and that's where we get a lot of a positive from, given the fact that there has been an improvement in both growth in revenues. I think even equally the loss ratios have been largely maintained, and the fact that the expense of management has been within the regulatory stipulations that has been laid out. So I think, which is where if you look at the combined ratio trajectory, I think that's looking very well for us, in line with what we have been talking to the market as well. And for the exit of Q4 of FY25, we have spoken about a combined ratio exit of about 101.5. So if you look at in that context, I think directionally for us, the combined ratio trajectory is moving in that direction. As I said, aided by renewed growth momentum, obviously a lot of focus on the loss experience, and more importantly, efficiency and productivity in the way we are running our operations. But from an absolute underwriting outcome, given the fact that the expenses are taken upfront, whereas the earnings of premium happen over a period of the contract of insurance.
So the combined ratio has improved to 102.3 versus 103.8. Which segments saw the biggest improvement this time in terms of combined ratio, and what's the FY25 target on the combined ratio? Also, what will that journey look like quarter on quarter now?
So again, if you were to put that in the context of the market, I think if you look at the market is, as I said, still elevated at an aggregate level as 102, 112. Within that, I think if you look at motor as a category, which by far is, of course, the second largest to the industry revenues, that has obviously seen some improvement from 121% to, let's say, 118. But it is still elevated. Now, obviously, the trajectory that motor combined ratio takes and the industry combined ratio takes is something that we will very, very closely watch for. But at this point of time, I will take the second question first of yours in terms of how do we see the exit of combined ratios for ICICI Lombard towards end of FY25. At this point of time, we are sticking to the thought process that we have spoken to the market, which is, as I said, trying to get to a combined of 101.5% by exit of Q4 FY25. This obviously is in the context of how the market environment plays out, and that's something that we will very, very closely watch out for. Your first point on where have we seen the improvements in the combined ratios, I think, as I said, it's been all round. I think in general for us, we have been able to see an improvement in our combined ratios on commercial lines. Even for us, motor, I think the combined ratios improved relative to the last year. And even on the health side, I think on the corporate health specifically, given the fact that we are able to win accounts at our price, again, I think the combined ratios have been positive. On retail health, I think at this point of time, given that we are making those investments in expansive distribution, obviously the combined ratios for the time that we continue to make these investments, the combined ratios will stay elevated. But what we are happy about is the fact that it is running at a loss experience that we are comfortable with.
I've got it. Gopal, now loss ratios in health segment spiked to 83.6% as compared to 78.7%. Was it because of individual or the group segment? And what would be the target to reduce the loss ratios in the health business too, both retail and group? If you could detail that out for us.
Again, as we kind of put out even as a part of the earnings call, on the health side, again, if you look at for Q1, specifically of this period, I think what we have seen is possibly some elevated increase in frequency of claims. And obviously to some extent also an increase in the average claims cost as well. But that's something that we will watch for. Q2 in general for health is slightly elevated consequent to the monsoon season. So therefore we do see some increased incidences of claim. But having said that, I think for the rest of the year, insofar as both the segments that you kind of talked about, whether it is corporate health or whether it is retail health, I think the loss ratios range that we're comfortable on the corporate side is generally in the range of about 94 to 95%. And on the retail side, I think we're comfortable operating at a loss ratio of about close to 70%. So the good news is, I think the kind of the portfolio book that we are building up possibly gives us a confidence that we should be able to end the year at those levels of loss ratio ranges.
All right, Gopal, for health, the growth in the premium for retail segment moderated, whereas the employer-employee was strong. What's the management's intention to grow retail or the employer-employee? And what share do you see retail and group by the end of this fiscal?
So if you ask us, health as a category is a preferred segment for us. Now that obviously kind of includes both, as you rightly mentioned, employer-employee as well as, let's say, the retail health. Now, when it comes to employer-employee, effectively as what I was talking about, in the past, there have been challenges from a market perspective. The market, because the loss ratios for that segment was significantly elevated. Now, obviously, thanks to some of the improvements in pricing that the market has seen, which is why I talked about the fact that for ICICI Lombard, we have been able to win accounts at a price at which we are comfortable with. And hence, that gives us the confidence that we should be able to run that book broadly at a loss ratio range anywhere between 94-95%. But if you ask us, is that an area of thrust? Of course, it's an area of thrust, given the fact that there is an improved pricing sentiment that is playing out in the market. So hence, to that extent for ICICI Lombard, that's a very, very preferred segment. On the retail side, again, as I mentioned, that's an area where currently we are in an expansive mode. And thankfully, the way we have been kind of expanding the book, as I said, again, is leading to a loss outcome broadly at a loss ratio range that we're comfortable with, which is at about 70%.
Are you looking to take any price hikes in your health portfolio?
If you ask us, I think at this point of time, we believe we are fairly priced in terms of the health insurance offerings that we have, particularly on the retail side, given the fact that that's a solution that we have kind of recently put into practice. But having said that, obviously, that's something that we will keep looking for in terms of the loss outcome of the portfolio that we're underwriting. At this point of time, as I indicated, I think the loss ratio range that we are largely comfortable with is operating on the retail side at about 70%. And to that extent, we believe, I think we are kind of fairly priced. But obviously, we will see the experiences play out over the subsequent quarters. And should there be a need for us to do any kind of a price revision, obviously, we will come back and talk to the market specifically about that. But more importantly, I think if you ask us, a larger focus for us is also on trying to manage the cost of claims. And to that extent, I think there's a lot of focus that the company has been kind of doing in order to make sure that we are also able to keep the cost of claims under check.
Got it. Now, loss ratio in the motor segment has also come down. It's down to about 66.8%. And in the property and casualty segment is down to about 74.9. Is there further scope, as you see it, to reduce loss ratios in these segments, and to what point?
On motor, as a category, I think generally we are comfortable running at a loss ratio range between 65 to 67%. And within that, we have talked about on motor own damage, a loss ratio range of between 60 to 65. And on third party, a loss ratio range between 65 to 70%. So that's in motor as a category. On the property and casualty, which is largely, let's say, the commercial lines, I think, again, we would keep saying that I think it's very difficult to look at it from a quarter-to-quarter basis, primarily because some of these catastrophic events can have an impact in the loss numbers for that particular given quarter. So let's say, for example, in a given quarter, you see 2-3 flood events or catastrophic events. But naturally, given the nature of the business, obviously, we will see some losses. But when you look at it over a longer period of time, which will kind of play out in terms of averages, I think at this point of time, commercial lines for us has been one of the best ROE generating segments of businesses as well. And that's a segment where for ICICI Lombard, we have been continuing to increase market share as well. And hence, therefore, to summarize, both on motor and the commercial lines, the loss ratios range over periods are kind of well within the range that ICICI Lombard is comfortable operating at.
Gopal, we'll leave it there. Thank you very much for joining us and running us through all of that detail and a fair bit of guidance as well as you see it. Thank you for your time. Well, let's talk about the next company, JSW Infrastructure, the ports companies in focus. They saw a muted start to the first quarter. Their volume growth in Q1 has been impacted by maintenance shutdowns. To discuss some of this in detail, we're now joined by Arun Maheshwari, Joint Managing Director and CEO at JSW Infrastructure. Mr. Maheshwari, great to have you with us here. Thank you for your time. Prashant this side. soft start to the year, we understand that volumes were impacted by maintenance shutdowns at Dolvi. Is that back up again? Is it up and running now? And second quarter onwards, can we expect volumes to come back to the 30 million ton run rate?
Yeah, the shutdown is over, and we'll maintain our guidance of 10 to 12% growth year-on-year basis for the full year volumes.
Okay, do you stick to your guidance that you gave earlier of 10 to 12% volume growth? And the second half, will we see a resumption of the Dolvi plant? Also, what is the kind of inorganic volume growth that we're looking at?
So, Navkar capacity, we are not adding up to our volume guidance, what we had projected earlier. But rest of the year, we expect 10 to 12% for sure. We'll be able to achieve that.
Well, tell us about the agreement with JSW Steel. This is sizable to your business, 30% of FY24 sales. You say it will generate mid-teen IRR. What's the rationale? And you envisage that shareholders push back from JSW Steel. What is the quantum of EBITDA contribution that you see from here?
Connectivity deal, because if you see our journey, we have been getting into the port connectivity, whether Navkar we talk about or whether slurry pipeline we talk about. It adds volume to our overall business, and to our port businesses becomes more and more robust by virtue of such deals. So this is one deal, such deal, which will greatly add value to our stakeholders. And it's completely in sync with our target of port connectivity projects. So I expect this to add decent volume and decent growth to our bottom line and top line both.
Mr. Maheshwari, give us a sense of the tax rate that will be applicable Q2 onwards, the effective tax rate going forward, and any tweaks to sort of, your internal assessment of PAT estimates.
So PAT remains as robust as it was. So this quarter PAT, if you see, it is a bit compromised. This is largely because of accounting entry. Last year, same quarter, we had a forex gain of about 87 crore rupees, which was not there in this quarter, which was an unrealized gain, and it's more to do with the accounting entries. So I think we remain as robust operationally as we were earlier. Going forward, our tax rate, if we say, in some ports, our Section 80I benefits are getting exhausted. So we'll maintain around 24 to 25% kind of tax rate would be there.
Okay, sir, but tell us about the rationale behind the acquisition of Navkar Corp. How does it aid your portfolio? How much JSW Group volumes was it handling? And also give us a couple of operational metrics as well as financial metrics, the improvement that you're looking at.
So if you see our journey, we started in 2002, 2004 as a captive port company. Till good 15, 16 years, we were doing only captive businesses. Thereafter, we ventured into the third-party businesses, which was 6% in 2019, grew to 50% in Q1 FY25. This is the natural extension of Navkar. You serve through the port to our customers, and thereafter you have to get into the last mile connectivity, last mile delivery, customer delight, and making the customer more and more stickier to you. So this is one such step we have done. It's a natural progression for any port company to get into last mile connectivity. This is where we are getting into the phase now, and Navkar is first such acquisition for us. So we would like to make operationally very, very robust this particular company. Very, very strategic locations. They are rail connected, whether it's in Mumbai or whether it's in Gujarat. So far as JSW volumes are concerned on Navkar, it's very minuscule. Rather, I would say maybe around 5% of the total volumes would be JSW Steel. Otherwise, it's a very, very independent, and it is largely targeted towards the inland deliveries for containers or stuffing, de-stuffing, or cement players and other people.
So you've mentioned a lot of scope of growth after signing the concession agreement with Chidambaram Port in Tamil Nadu to develop a new 7 million ton cargo berth, and also further discussions are underway for equipment specs and ordering. Can you tell us a little bit about that?
It's one of the very, very fine acquisitions or bidding, securing a winning bid over there. It's an operating terminal. This is an operating port. So hinterland is very rich. About 10 to 12 million ton of cargo is immediately seen within next 20 to 50 kilometers of that port, and there is absolutely no competition nearby over there. We expect it to be operating almost 80 to 100% in the first year of operation itself. So we feel it's one of the finest bidding when what we have done in the recent past.
Mr. Maheshwari, you had mentioned a 30,000 crore capex plan rupees 30,000 crore capex plan. Can you confirm this figure? And what are the other new opportunities? You said in last mile connectivity, Navkar is the first such step. What are the other opportunities to deploy this money?
So these 30,000 doesn't include any of the acquisitions, because acquisitions we don't know how much we'll do and what we will do as the opportunity comes in. These are the defined and identified project which we have done so far. Few of the things we have already mentioned in our previous calls, whether it's a Keni or Jatadhar or upgradation of Tuticorin or upgradation of Jaigarh Port, Dharamtar, JNPA. Then a few more investments into nearby Navkar and other terminals. So these are defined projects what we have, ancillary pipeline I just mentioned. So these are defined projects what we have laid down till 2030. Any acquisition or any further bidding to any of the terminals or any other opportunity coming up, it would be over and above 30,000 crore rupees. It all depends upon how the balance sheet fares and how we see the leverage ratios in our system.
Okay, well, that is on the capex. But I also wanted to ask you about these reports indicating that JSW Infrastructure is set to win the Murbe port deal. What is the official word here? What capex is required? How is the location good for you? And what volumes can be seen?
So we are awaiting, as of now, Maharashtra Maritime Board's outcome. If it comes to, then it would be a very good value addition, because the way our Dolu plant is expanding, the way we see our Wasin and Tarapur plant expanding, and the nearby hinterland what is there, this port will certainly help us to develop that. But as of now, we are awaiting feedback from Maharashtra Maritime Board.
Okay, thanks a lot for joining in. We'll slip into a quick break. On the other side, we'll connect with Nitish Ranjan, the Executive Director of Union Bank of India, to discuss their Q1 earnings. Stay tuned.
Welcome back. We are continuing with our earnings analysis, and now we focus on Union Bank of India. For the first quarter, the bank saw elevated write-offs which have aided bringing down their GNPAs. Also, their provisions, the overall provisions are up 40%, but NPA provisions are down. In fact, provisions are up 120% sequentially. To discuss more about the performance, we are now joined by Nitish Ranjan, the Executive Director at Union Bank of India. Mr. Ranjan, good morning, and thank you very much indeed for your time. Well, let me start with the NPA, since that's something that's gone down significantly. Your guidance was actually 4%, and still at 4.54. When do you hit 4?
Yeah, good morning. So far as the NPA is concerned, we have given a guidance for the current financial year that by March 2025 will be below 4%. And in line with that, we have been able to bring down the gross NPA further to 4.5% for the quarter ended June. And we are very hopeful the kind of delinquency guidance we have, recovery pipeline that we have, that will be able to achieve our guidance of below 4% gross NPA by March 25.
Okay. But I must remind you that the Reserve Bank put out in June the financial stability report, and there the average for the whole country, banking sector, the GNPA is 2.8%. You're almost double that figure. So one would expect a faster reduction of NPAs. Do you hit 4 in the first half itself, or will it take the whole year? Will you go up until the fourth quarter?
Definitely the endeavor would be to achieve below 4% well in advance of the guided timeline. But I also request you to appreciate the fact that if you look 2 years back, our gross NPA used to be over 10%. And from that high level, we have been able to bring it down to around 4.5%.
No, I agree. The whole sector was almost at 10%, if you remember. So all banks have had this problem, and one is only looking for a faster reduction. Your NPA provisions have gone down significantly, now at 1,600. Is there more scope for those provisioning to go down? I mean, for credit costs generally to come down?
Right. So credit cost last year was around 0.7. This first quarter also, we have been able to maintain at around 0.7. But I think it has the downside potential to go down further.
Okay. Your write-offs are fairly significant. Should we expect a similar number to continue?
I think write-offs, if you look at the average basis, whatever we have done in the last full year, compared to that, it's very low. And hopefully we'll be able to maintain the similar trend during the current financial year.
No, the reason I'm asking is that your restructured book is still big. Although it's coming down, it's come down 11%, it's still a nearly 12,000 crore book. So there is always this fear that there can be higher write-offs, but the advantage can be there can also be higher recoveries. Can you give us some guidance on recoveries?
Yeah, so for recovery this year, we have given a guidance of 16,000 crores of total recovery, of which in the first quarter, we have done close to 3,350 crores. And we are very hopeful that we will be able to achieve that target, given that we have around 41,000 crores of gross NPL on the book. And off the book, we have close to around 80,000 crores of written off accounts. So around 1.2 trillion of pool is there from where we have to do the recovery of 16,000 crores. Last year also, you'll note that we did a recovery of 18,500 crores. In fact, we surpassed our own guidance. So we are very hopeful and sanguine that this year also we'll be able to surpass the guidance of 16,000 crores of recovery.
Okay, no, that's very good to hear. Let me come to the other number also, which was extremely encouraging, that your slippages, the pace of slippages is falling. Can you give us an idea whether there is any stress at all? See, you know, in some of the banks, it looks like the fall of the NPA has bottomed out now. Even HDFC Bank reported a minor rise in GNPAs. Of course, it's seasonal. It's quarter one. Do you think you have more downsides? Or do you think that retail NPAs, for instance, can start rising?
No, we are not seeing any kind of trend, particularly in the retail, agri or MSME, that it is rising. If you look at even the quarterly incremental delinquency, even in agri and the MSME segment, it is close to around 2.5% only incremental delinquency, which shows that the asset quality at the current level is quite good. And the total slippage guidance we have given for the full year is 11,500 crore around. And we have been able to maintain on an average basis, if you look at Q1, around 2,300 crores. So that's quite possible that we'll be able to contain these slippages within the guidance level of 11,500 crores.
Okay.
We do not see any kind of signs of stress in the retail segment particularly.
Got it. That's good to hear. Your OPEX fell, scope to fall further? I mean, fell quarter on quarter.
We have always been guiding that the growth rate of OPEX will be in the range of 8 to 10%. This quarter, it has shown 10% YOI. So going forward, one can factor in 8 to 10% growth rate. And therefore, yeah.
Okay, got that. Just wanted to know about your non-NPA provisioning. That is high. Is there a chance that that can taper off?
Yeah, that will taper off. There was some one-off provisioning that we have made during the current quarter, but going forward, that should taper off and it should normalize.
Okay, just one word on margins. What do you expect it to be better, or do you think deposit cost is really hitting you? Anyway, first that number also. How much may your cost of funds go up in the current quarter and therefore margins?
So if you look at 12-month basis, cost of funds have almost gone by 40 basis points. So a lot of repricing has already happened. But over the next 2-3 quarters, some maybe 15-20 basis point inch up in cost of funds might happen, given the deposit repricing that we are seeing in the market. But given all these, we have given a guidance of NIM for the full year in the range of 2.8 to 3%. We are making our best efforts to ensure that we contain and we maintain our NIM in the upper range of this guidance, close to 3%. This quarter, we have been able to achieve that, and our endeavor would be to maintain it above 3%.
All the very best for that. Thank you very much, Mr. Ranjan, for joining us, and hope you have a great FY25. Okay, so that's the word from Union Bank, and the stock, as you can see, up 1.5%. Well-received numbers, especially the ROA of 1%. We have to take a break on that note, but now we have a lot more results to analyze. HDFC Bank, Kotak Bank, and a whole host of mid-cap banks, RBL, Yes Bank. So many have come recently. Shantanu Chakrabarti, India analyst of BFSI at BNP Paribas, joins in a minute after this break. Welcome back. Let's put the spotlight on the banking space, since we have had a bunch of very iconic banks announcing their numbers. Like I told you, HDFC Bank, Kotak Bank among them over the weekend. To decode the numbers, we have with us Shantanu Chakrabarti, the India analyst, BFSI, banking finance companies at BNP Paribas. Shantanu, good morning. Always a pleasure having you with us, and thank you for your time. Let me start with the big boy, HDFC Bank.
Thank you.
The stock itself is a bit in the green, but there are at least 10 reasons to be disappointed with whatever you pick other than margins. What's your first take? Just the margin increase, does it condone the miss on several other parameters?
So, I mean, Lata, the most of the bad news actually came in the pre-quarters, and incremental news on the quarterly release is what has positively surprised the markets. Now, this forms a nice counterpoint to the structure that we had last time, where the initial deposit mobilization and loan growth looked quite favorable to people, and then when the profitability numbers came in, they were disappointing. Now, look, I mean, the moment you looked at the fact that they had shed more than 5% of their corporate loan book in just one quarter, the fact that it would be constructive on margins was not that much of a stretch. In fact, therefore, we had expected numbers. Numbers are actually 1.5% below what we had expected, but higher than what the street had expected. It's not surprising for us. As far as the highlights go, two things stand out for me. One, which the company itself acknowledged in its quarterly call, which is that in the last 2 years, despite fairly tough circumstances, as far as incremental market share goes in the deposit space, it would have been hard to fault HDFC. It was not HDFC's fault that that their proportions on CASA, etc., could not be shifted too fast, because the system level numbers were fairly anemic. This is the first quarter where we can say, at least at an aggregate deposit level, the market share performance has not lived up to the standards set in the last 2 years. The other point which struck me a little bit, and I get it that this is the seasonally weakest quarter, and there would have been some disruption because of elections. But CRB numbers being as low as they were, which was my key disappointment from the pre-quarterly release as well, is a little off-putting, especially given their relevance to both margin defense as well as PSL compliance.
Sorry, your abbreviations are beyond me. What did you say? CRP?
So, CRB, Commercial and Rural Banking.
Okay. You're disappointed with the growth in commercial and rural banking.
Rural banking, that was only 0.8% sequentially.
Okay. So do you think that the fact that they have to make up for some of their priority sector shortfalls in individual categories, though overall they meet, of course, do you see that being impinging on their margins? Is that a long-term worry for you, or at least a medium term?
I don't want to extrapolate just one quarter's performance, but what I would reiterate is this segment is crucial in two ways, just as you have mentioned. One is the simple priority sector compliance. The other is it's a fairly high yield sector, relatively high entry barrier vis-a-vis a lot of the other prime categories. And they have made so much of investments into, setting down new branches. So, from that perspective, the performance of this segment is something we have to watch very closely, because a lot of the bull thesis depends on this.
Okay. Very quickly, what's your price target and call on the stock?
Yeah, so it's our top pick within the banking space. Our price target is 2470. At least until I looked about a couple of weeks back, it was the highest on the street. And
okay, obviously,
इस पवित्र दिवस पर एक महत्वपूर्ण सत्र का प्रारंभ हो रहा है और सावन के इस पहले सोमवार को मैं देशवासियों को बहुत बहुत शुभकामनाएं देता हूं। आज संसद का मानसून सत्र का भी आरंभ हो रहा है। देश बहुत बारीकी से देख रहा है कि संसद का यह सत्र सकारात्मक हो, सृजनात्मक हो और देशवासियों के सपनों को सिद्ध करने के लिए एक मजबूत नींव रखने वाला हो। साथियों, भारत के लोकतंत्र की जो गौरव यात्रा है, उसमें ये एक महत्वपूर्ण पड़ाव के रूप में मैं देख रहा हूं। व्यक्तिगत रूप से मुझे भी, हमारे सभी साथियों को भी ये अत्यंत गर्व का विषय है कि करीब 60 साल के बाद कोई सरकार तीसरी बार वापस आए और तीसरी पारी का पहला बजट रखने का सौभाग्य प्राप्त हो। ये भारत के लोकतंत्र की गौरव यात्रा की अत्यंत गरिमापूर्ण घटना के रूप में देश इसे देख रहा है। ये बजट सत्र है, मैं देशवासियों को जो गारंटी देता रहा हूं, क्रमशः रूप से उन गारंटियों को जमीन पर उतारना, इस लक्ष्य को लेकर के हम आगे बढ़ रहे हैं। ये बजट अमृतकाल का एक महत्वपूर्ण बजट है। हमें 5 साल का जो अवसर मिला है, आज का बजट हमारे उन 5 साल के कार्य की दिशा भी तय करेगा और ये बजट 2047 जब आजादी के 100 साल होंगे, तब विकसित भारत का जो हमारा सपना है, उस सपने को पूरा करने की मजबूत नींव वाला बजट लेकर के हम कल देश के सामने आएंगे। हर देशवासी के लिए एक गर्व की बात है कि भारत बड़ी इकोनॉमी वाले देशों में सबसे तेज गति से आगे बढ़ने वाला देश है। गत 3 वर्षों में लगातार 8% ग्रोथ के साथ, 8% ग्रोथ के साथ हम आगे बढ़ रहे हैं, हम ग्रो कर रहे हैं। आज भारत में पॉजिटिव आउटलुक, इन्वेस्टमेंट और परफॉर्मेंस एक प्रकार से अपॉर्चुनिटीज की पीक पर है। ये अपने आप में भारत की विकास यात्रा का एक अहम पड़ाव है। साथियों, मैं देश के सभी सांसदों से, किसी भी दल के क्यों न हो, मैं आज आग्रहपूर्वक कहना चाहता हूं कि हम गत जनवरी से लेकर के हम लोगों के पास जितना सामर्थ्य था, उस सामर्थ्य को लेकर के जितनी लड़ाई लड़नी थी लड़ ली। जनता को जो बात बतानी थी बता दी। किसी ने राह दिखाने का प्रयास किया, किसी ने गुमराह करने का प्रयास किया, लेकिन अब वो दौर समाप्त हुआ। देशवासियों ने अपना निर्णय दे दिया। अब चुने हुए सभी सांसदों का कर्तव्य है, सभी राजनीतिक दलों की विशेष जिम्मेवारी है कि हमने दल के लिए जितनी लड़ाई लड़नी थी लड़ ली। अब आने वाले 5 वर्ष के लिए हमें देश के लिए लड़ना है, देश के लिए जूझना है, एक और नेक बनकर के जूझना है। मैं सभी राजनीतिक दलों से भी कहूंगा कि आइए हम आने वाले 4 साढ़े 4 साल दल से ऊपर उठ करके सिर्फ और सिर्फ देश को समर्पित होकर के संसद के इस गरिमापूर्ण मंच का हम उपयोग करें। जनवरी 29 जब चुनाव का वर्ष होगा, आप उसके बाद जाइए मैदान में, सदन का भी उपयोग करना है कर लीजिए। वो 6 महीने जो खेल खेलने खेल लीजिए, लेकिन तब तक सिर्फ और सिर्फ देश के गरीब, देश के किसान, देश के युवा, देश की महिलाएं, उनके सामर्थ्य के लिए, उनको एम्पावर करने के लिए जन भागीदारी का एक जन आंदोलन खड़ा कर करके 2047 के सपने को पूरा करने के लिए हम पूरी ताकत लगाए। मुझे आज बहुत दुख के साथ कहना है कि 2014 के बाद कोई सांसद 5 साल के लिए आए, कुछ सांसदों को 10 साल के लिए मौका मिला, लेकिन बहुत से सांसद ऐसे थे जिनको अपने क्षेत्र की बात करने का अवसर नहीं मिला, अपने विचारों से संसद को समृद्ध करने का अवसर नहीं मिला, क्योंकि कुछ दलों की नकारात्मक राजनीति ने देश के संसद के महत्वपूर्ण समय को एक प्रकार से अपनी राजनीतिक विफलताओं को ढांकने के लिए दुरुपयोग किया। मैं सभी दलों से आग्रहपूर्वक कहता हूं कि कम से कम जो पहली बार सदन में आए हैं, ऐसे बहुत बड़ी संख्या में हमारे माननीय सांसद हैं और सभी दल में हैं, उनको अवसर दीजिए, चर्चा में उनके विचारों को प्रकट करने का मौका दीजिए, ज्यादा से ज्यादा लोगों को आगे आने का अवसर दीजिए। और आपने देखा होगा कि पार्लियामेंट के नए संसद गठन होने के बाद जो पहला सत्र था, 140 करोड़ देशवासियों ने बहुमत के साथ जिस सरकार को सेवा करने का हुक्म किया है देशवासियों ने, उसकी आवाज को कुचलने का और लोकतांत्रिक प्रयास हुआ। 2.5 घंटे तक देश के प्रधानमंत्री का गला घोंटने का, उनकी आवाज को रोकने का, उनकी आवाज को दबाने का लोकतांत्रिक परंपराओं में कोई स्थान नहीं हो सकता है और इसका कोई पश्चाताप तक नहीं है, दिल में दर्द तक नहीं है। मैं आज आग्रहपूर्वक कहना चाहता हूं, देशवासियों ने हमें यहां देश के लिए भेजा है, दल के लिए नहीं भेजा है। ये सदन दल के लिए नहीं, ये सदन देश के लिए है। ये सदन सांसदों तक की सीमा तक नहीं है, 140 करोड़ देशवासियों की एक विराट सीमा करके ये लिए है। मैं विश्वास करता हूं कि हमारे सभी माननीय सांसद पूरी तैयारी के साथ चर्चा को समृद्ध करेंगे। कितने ही विरुद्ध विचार होंगे, विरुद्ध विचार बुरे नहीं होते हैं, नकारात्मक विचार बुरे होते हैं। जहां सोचने की सीमाएं समाप्त हो जाती है, देश को नकारात्मकता की जरूरत नहीं है। देश को एक विचारधारा, प्रगति की विचारधारा, विकास की विचारधारा, देश को नई ऊंचाइयों पर ले जाने वाली विचारधारा से हमें आगे बढ़ाना होगा। मैं पूरा ही आशा करता हूं कि हम लोकतंत्र के इस मंदिर का भारत के सामान्य मानवीय की आशा आकांक्षाओं को पूर्ण करने के लिए सकारात्मक रूप से उपयोग करेंगे। बहुत बहुत धन्यवाद साथियों।
Okay, that was an unusually long Parliament introduction speech. And at the start, when he spoke about the 5 years laying the foundation for a developed Viksit Bharat, the Nifty and more importantly, the mid-cap index did see a slightly higher level. But if you pull up the mid-caps, it lost some of it, I think, as it became a slightly political speech. But there you are. There is chance that the budget will announce something which is valid and giving us a 5-year roadmap. On that hope, wrap up on Bazaar chart process coming up.